Okay, so we'll start now. Okay, so yesterday we did section 54 and we solved one question also on section 54, right? No? So today the balance part will complete. Capital gain will be finished today. Okay, pay attention now. See, section 54 was the exemption for long term gain. Yes or no? Long term gain arising on transfer of residential house property. That long term gain was exempt because we were investing in new residential house property. Okay, so whatever gain which got invested in new residential house property, to that extent the gain will be exempt. Now coming to the next section, 54b. 54b says that if you are an individual or HUF, you have transferred one urban agricultural land. So now what type of asset you have to transfer? You have to transfer urban agricultural land. Okay. Because rural agricultural land is not a capital asset. And if you transfer, capital gain will not arise. So what type of land you have to transfer? Urban agricultural land. Now this urban agricultural land was used for at least 2 years for residential purpose. No, for agricultural purpose immediately prior to its transfer. So immediately prior to its transfer, for minimum 2 years, it must be used for agricultural purposes. Now sir, something like this we have already seen. Do you remember? 10 subsection 37. So there, the same urban agricultural land you transfer. If you are individual HUF, you transfer. No, you don't transfer. Compulsory acquisition happens. Here what is written? Transfer. There 1037 compulsory acquisition was there. So if the urban agricultural land is compulsorily acquired, this type of agricultural land compulsorily acquired, so the capital gain which you would have calculated under section 45(5), that capital gain, whether short term or long term, would have been fully exempt. If the urban agricultural land was used by you for at least 2 years for agricultural purpose immediately prior to its compulsory acquisition, and the compensation was approved by the CG or RBI, only in that case you are not required to calculate the capital gain. That is full exemption. There you are not supposed to invest also. So we are not talking about that case over here. Okay, no. This is transfer, any type of transfer. Sale, exchange, relinquishment, conversion, any type of transfer. Now see, whenever the transfer happens, it can also include compulsory acquisition. But in that case, the compensation will not be decided or approved by the CG or RBI. Then even that compulsory acquisition capital gain will be covered here. Getting my point? So the capital gain which is not covered by 1037, which is not fully exempt, the capital gain which is taxable. So urban agricultural land, it must be that urban agricultural land which is used for agricultural purposes for at least 2 years immediately prior to its transfer. Okay. By transferring that urban agricultural land, you will get short term or long term capital gain. Any type of capital gain you can get. That capital gain will be exempt under section 54B. You want the exemption of 54B? Yes. So you have to invest in new asset. What asset you are supposed to acquire now? You are supposed to acquire any agricultural land in India. It can be rural also, it can be urban also, will not make any difference. So can you buy rural agricultural land? Yes. Can you buy urban agricultural land? Yes. But you have to purchase that urban agricultural land or rural agricultural land in India. within 2 years, within 2 years from the date of transfer of original urban agricultural land. So from the date of transfer of this urban agricultural land, from the date of transfer of this urban agricultural land, 2 years after this, yes or no? Within that 2 years, you are supposed to acquire new agricultural land. We will assume that the new agricultural land which you have acquired within this period was out of this long-term gain only. If the investment is made within this 2 years, no, we will assume that the investment was made out of this capital gain only. This capital gain invested in new asset, yes or no? And accordingly, based on that investment, we are going to give you what? Exemption. Based on that investment, we are going to give you exemption. Understanding? Everyone, how much amount will be exempt? If the entire long-term gain invested, if the investment amount is more than or equal to capital gain, then the entire amount is invested, no? Entire capital gain exempted. If the amount of investment is lower than capital gain, then have you invested the entire gain? No. So the gain to the extent of investment, that gain will be exempt. Yes or no? So this will be your exemption. Amount of capital gain or amount of investment, whichever is lower. Okay. Now pay attention. Pay attention. You have to invest within 2 years in any agricultural land. Whatever investment you have made, that investment will be considered as if that investment is happening out of capital gain. Now 2 years time they have given. How much time they have given? 2 years time. That 2 years time, can I say it is not a small period of time, it is a considerable time. So can I say, just like the CGD option which I was getting under section 54, I should get a CGD option over here also. Because what if I have transferred my urban agricultural land in previous year 24-25? Yes or no? And from the date of transfer, I have to count 2 years. From the date of transfer, I have to count 2 years. Okay, now. So for example, my urban agricultural land got transferred in 24-25. So this was 24-25. My urban agricultural land got transferred on 12th of November 2024. This is the date of transfer of my urban agricultural land. From this date, I have to count 2 years. From this date, I have to count 2 years. So can I say it will be 12th of November 2026? So within the period of these 2 years, I have to purchase a new agricultural land. So if I have purchased within this period, it will be assumed as if my capital gain is invested. Yes or no? But don't you think that even before the period of 2 years gets over, even before that, I will have to file my return of income? I will have to file my return of income for 24-25, no? So for 24-25, my return will be filed. Due date of return of income will come on 31st of July. Can I say 31st of July? My due date will come. It can be 31st October also, yes or no? But I am taking an example, 31st July, my due date will come. So don't you think that this capital gain, I will have to show in this return? And from this capital gain only, I am going to take the exemption, no? But exemption will be available only if I purchase. But the purchase has not taken place within this time. I want to purchase in the balance time available. Yes or no? And if I purchase in this time, I am not going to get any exemption from my return because the return is already filed and I have already shown my capital gain taxable in that return. But from that capital gain, now if I want to claim the exemption, I will not be able to claim, no? So if I want to claim the exemption, I will show this capital gain as taxable in my return. But I will have to compulsorily purchase the agricultural land within this period. Only then I will be able to claim the exemption. Then they should have told me that invest on or before the due date. Why they are giving this extra time? They should not have given this extra time also, no? So to avoid such hardships, they are giving the option of CGD account, capital gain deposit account. Go to any nationalized bank, open a CGD account, and in that CGD account deposit some money. The money which you have deposited in this account must be deposited on or before the due date of filing your ROI. And if you deposit that money, it will be assumed as if it is invested in purchase. Purchase of what? Agricultural land. But remember, the amount which you have deposited in CGD account, to this extent, your capital gain can be exempted. But remember, when you will withdraw this amount, you have to, within this time, on or before 12th of November, you have to use that entire amount to purchase the agricultural land. If you withdraw that amount and use, meaning utilized, what if you withdraw that amount and misutilize? Then based on the amount invested in CGD, did you get the exemption? Yes. See, the investment which I am talking about here, this investment, the amount invested or the capital gain, whichever is lower, that will be exempt, no? Hello, sir. So for example, this investment is happening in purchase, then there is no problem. But if I cannot purchase on or before the due date, I have the option to deposit in CGD also, no? So whatever amount I have deposited in CGD will be assumed as if I have invested in, as if I have invested my capital gain in purchase of new agricultural land. But I have not actually purchased. I have just deposited that amount in CGD so that I can claim the exemption in my return. So now deposit made in CGD, based on this amount I have claimed the exemption. The amount which I deposited, to that extent I got the exemption in my return from my capital gain. This much capital gain got exempted. So that time you promised, no, that this CGD account you will withdraw money and use in the balance time. Within this given time you will use in purchase. So what are you doing? Now you are withdrawing that money from CGD and using for some other purpose, misutilizing. So the year in which you misutilize that amount, in that year, the entire amount which you have misutilized will be your deemed capital gain. It can be deemed short-term gain also, it can be deemed long-term gain also, depending on the fact that what type of gain was exempt. Yes or no? Now, if this period of 2 years has expired and still some amount is remaining in your CGD account, meaning that amount which was supposed to be invested within this period for purchase, you could not invest, then why have you taken the exemption for this amount? So you'll have to reverse that also. So the amount which remains unutilized on the expiry of 2 years, from your CGD account, so that entire amount will be treated as your deemed short-term gain or long-term gain for the year in which the period of 2 years expire. Done. This exactly same thing we have done for section 54 also. So I should not have taught also. I would have told you that the same thing is there. Now again it will come, I will not tell you. This was just a revision for you. Will you remember? Now see, the new agricultural land should be purchased in India. Is there any restriction that how many land you can purchase? You can purchase any number of land. No problem. The land should be agricultural land. So whatever amount you have invested within this time in any agricultural land, entire amount can be claimed as exempt, subject to the availability of capital gains. Yes or no? Hello? So there is no requirement that only one land should be purchased. Entire investment in all the land, all the agricultural land can be considered for exemption. Next thing, The land can be rural also, land can be urban also. There is also no restriction on that. And also there is no restriction that to the extent of this much amount only can be invested. Your investment cannot be more than this amount. The cost of the new land cannot be more than this amount. That restriction was there in section 54. Do you remember? How much was the maximum amount? 10 CR. Yes. So up to 10 crore, you can invest in new residential property. So the cost of new residential property cannot be more than 10 CR. Here there is no such restriction. Getting my point? Whatever amount you have invested, whatever is the cost of new agricultural land, to that extent you can claim the exemption, provided your capital gain is that much. Okay, sir. Now the new agricultural land, its lock-in period is also 3 years. Just like the last section. There, the lock-in period of new residential house property was 3 years. So here also, the lock-in period of new agricultural land, the lock-in period is how much? 3 years from its date of acquisition. So if you transfer the new agricultural land within 3 years from the date of its acquisition, then whatever cost of that new agricultural land which you have financed through capital gain, meaning the capital gain which was invested in the cost of that land, which got exempted under section 54B, to that extent the cost will be taken away. Do you remember something like that we did for residential property also? So for example, my capital gain under section 54B, my capital gain was long-term capital gain, okay, on transfer of urban agricultural land. The gain was 80 lakhs. How much? 80 lakhs. Okay. Now if I want to claim this exemption for this, what should I do? I should invest, I should purchase a new agricultural land. So for example, I have purchased new agricultural land worth 75 lakhs. Can I purchase? But this purchase is made within the given time of 2 years. Yes or no? Maybe even before the due date of filing ROI. Hello, sir. So this was invested, the amount 75 lakhs is invested out of 80 lakhs only. Because the investment in this new land, the cost of this new land is out of this capital gain only. So this is what? Investment. This is nothing but cost of new land. So if this new land which I have acquired for 75 lakhs is assumed to have been acquired out of my capital gain, so can I say this much amount of capital gain I can exempt? Yes or no? So less what? Exempt under section 54B. How much will be exempt? The amount of long-term capital gain which was 80 lakhs or amount of investment which was 75 lakhs, whichever is lower, meaning 75 lakhs exempted and the balance 5 lakhs was taxable. Done, sir? So can I say the capital gain out of 80, 75 lakhs capital gain was exempted? That 75 is nothing but the cost of this land only, no? Now the minimum lock-in period for this land, new land, whose cost you have claimed as exempt capital gain under section 54B. Yes or no? This cost only you have claimed as exempt under 54B, no? Now remember this land, minimum lock-in period 3 years. If you sell the land within 3 years, for example, within 3 years you are selling the land for 90 lakhs. So will you calculate the capital gain for new land? Yes. So this 90 lakh will be the full value of consideration minus transfer expense, assuming that nothing 90 lakh will be the full value of consideration. Now what will be the cost? Cost will be 75 lakhs, sir. The land is acquired for 75 lakhs, so the cost should be 75. So if the cost should be 75 lakhs, the capital gain should be 15 lakhs only. But they are saying no, this entire cost was the amount of capital gain which you got exempt under section 54B. So out of this cost, how much amount of cost you exempted under section 54B? Full 75? No. Eliminate full 75. No cost will be allowed. No cost will be allowed, meaning your capital gain will be 90 lakhs. Yes or no? Now if I twist this example, for example, here the cost of the land was 90 lakhs. Possible or not? What was the cost? 90. So I would have taken the investment of 90, but I would have got the exemption of 80 only, no? Hello? So can I say out of 90, 80 was the capital gain which got invested? So entire 90, the cost of the new land is not exempted. Yes or no? Only 80 out of this 90 was invested out of the capital gain. So to the extent of that 80, the cost will be taken away. So whenever I'll sell the asset for now, for example, I'm selling that asset for 95 lakhs. I'm selling for 95 lakhs. So cost will be 90 lakhs, then capital gain will be 5. No. Cost will not be 90. Out of 90, 80 lakh was the amount which we got exempt. Yes or no? So out of this, remove 80. How much will remain? Only 10. Only 10 cost you will be allowed. So your capital gain will automatically become 85. 80 lakh capital gain will increase. Sure, sir. Should I move ahead? This was your 54B. But remember, in 54B, no, what if this agricultural land was rural agricultural land? Can I still get the exemption? Yes or no? Even if it is rural, I will still get the exemption. But wait, if this rural agricultural land is sold within 3 years, revocation will not take place. Why? Because revocation will happen, the amount of capital gain which was exempt under section 54B, to that extent the cost will be reduced. But there will be no capital gain calculated on its transfer because this is a rural agricultural land. Yes. So there will be no revocation which will actually happen. That is a small loophole over here. Okay. So if you are buying a rural agricultural land, buying that, you can get the exemption under 54B. Okay, no. But if you sell that rural agricultural land within 3 years, then sir, then no need to revoke any cost. No need to revoke your exemption. Because even if you will revoke, you will not be calculating the capital gains. Asset is rural agricultural land, which is not a capital asset. No capital gain will be calculated. Done, sir? This was your 54B. Now pay attention, pay attention. Sir, now you are any person. Any person. Okay. Now you have transferred land or building by way of compulsory acquisition. What, sir? Compulsory acquisition. Transfer by way of sale? No. Only compulsory acquisition. So if the land or building was transferred by way of compulsory acquisition, and this land or building must be used for industrial purposes for at least 2 years immediately prior to its compulsory acquisition? Yes or no? Then whatever capital gain which you will calculate it. Now the capital gain will be calculated under section 45(5) only, no? Because on compulsory acquisition, the capital gain is calculated under section 45(5). Do you remember that? So now the capital gain will be calculated under section 45(5). Now whenever you will calculate the capital gain can be short-term capital gain also, it can be long-term capital gain also. Yes or no? Now this you can exempt. You can claim as exempt under section 54D. So under section 54D, any capital gain which arises on compulsory acquisition, only that will be exempt. But this should be on compulsory acquisition of any land or building used for industrial purposes for minimum 2 years immediately prior to its compulsory acquisition. Yes or no? Only that gain can be claimed as exempt under section 54D. Now if you want to claim this exemption, what you are supposed to do? You are supposed to invest this capital gain in the new asset. So what asset you will buy? The same type of asset. Land or building for industrial purpose. New land or new building you are going to buy. Or new building you are supposed to construct. Or even CGD. New land, new building must be purchased within how much time? 3 years forward. New building should be constructed within 3 years forward. Will you remember? 3 years forward. Meaning that the date of transfer, from that date 3 years you will count. No. Transfer is compulsory acquisition. Capital gain is not taxable in the year of compulsory acquisition. Capital gain is taxable in the year of receipt of compensation. Do you remember? So in case of compulsory acquisition, the capital gain is taxable in the year of receipt of compensation. So for you, the date of receipt of compensation becomes important. From that day for next 3 years. Yes or no? There also in residential property, section 54, section 54B, in all the sections, wherever there is a compulsory acquisition and the capital gain, see, residential property, residential house property transferred by way of what? Compulsory acquisition. Now the capital gain under section 45(5) will be calculated. Yes or no? Now can I exempt this capital gain under section 54? The answer is yes. Even this capital gain can be exempted. Transfer of residential house property by any mode, sale, exchange, relinquishment, any capital gain, long-term capital gain on transfer of residential property will be exempt under section 54, provided you invest in the new residential property. Yes or no? So the investment should happen within 1 year backward, 2 years forward from the date of transfer, 3 years forward from the date of transfer. But if the capital gain which you want to claim as exempt was calculated under section 45(5), it was on compulsory acquisition, then the investment should not happen within 1 year backward, 2 years forward from the date of compulsory acquisition. No. Investment should happen within 1 year backward, 2 years forward from the date of receipt of compensation. The new residential house property should not be constructed within 3 years from the date of compulsory acquisition. No, it should be constructed within 3 years from the date of receipt of compensation. So whenever you try to claim the exemption of this type of gain, 45(5), the time limit for investment in new asset has to be counted not from the date of transfer but from the date of receipt of compensation. Everywhere. What if the asset was converted into stock in trade? In that case, the date of conversion, from that date you are not supposed to count. You are supposed to count from the date of sale of stock in trade, because that is the date based on which your capital gain is supposed to be charged. Hello sir, are you understanding what I am trying to tell you? So here, when you will see in section 54D, the capital gain is arising on compulsory acquisition. So this entire capital gain will be taxable in the year in which the compensation is received for the first time. No. So the period of investing in the new asset has to be counted not from the date of compulsory acquisition, but from the date of receipt of compensation. So either you invest within that date. Hello, if you invest within that date, so whatever investment is made within that period, counted from the date of receipt of compensation, within that period, whatever amount you invest in the new asset, to that extent your capital gain can be exempted. So now, how much will be the exemption? The amount of short-term capital gain or amount of long-term capital gain, either this amount or what? The amount of investment. Now where you are supposed to invest? This or this, whichever is lower. Yes or no? Where you are supposed to invest? Come on, tell me. Either purchase of what? Land or building for industrial purpose. Hello sir. Land or building for industrial purpose. Or you can construct what? Construction of building, because you cannot construct land, no? So you will construct building for industrial purpose. Purchase should happen within 3 years forward. Construction should be completed within 3 years forward. So this 3 years has to be counted not from the date of transfer. It has to be counted from the date of receipt of compensation. Understanding? Or you have the option to invest in CGD account. The answer is yes. You have the option to invest in CGD account. So within how much time you have to invest? You have to invest on or before due date of filing what? ROI. Due date of filing the ROI for which year? ROI of the year in which compulsory acquisition took place? No, ROI of the year in which the compensation is received, because that is the year for which the capital gain is going to be taxed. Getting my point, sir? Hello, sir. Now the new asset which you are buying, if you are acquiring this on or before the due date of filing your ROI, then whatever investment you have made in this asset, hello, to that extent your capital gain will be exempt. But if you cannot invest in the asset on or before the due date, you have option to invest in CGD also. Whatever amount you will invest in CGD account, capital gain deposit account, to that extent your capital gain can be exempted, assuming that the amount deposited in CGD is invested in land or building for industrial purpose. Yes or no? But remember, CGD account, the amount invested in CGD account was exempted. Whenever it will be withdrawn, if you will misutilize, what happens you know now? If that amount remains unutilized on the expiry of this 3 years, yes or no? Because the maximum time was 3 years. So on the expiry of 3 years, whatever amount remains unutilized in the CGD account, even that amount will be treated as your deemed capital gain, taxable in the year in which the period of 3 years will expire. Okay. Amount withdrawn from CGD account and misutilized, it is used for some purpose other than purchase or construction of land or building for industrial purpose. Yes or no? So the amount which was misutilized, that amount will be treated as your deemed capital gain, taxable for the year in which it was misutilized. And remember, the new asset which you have acquired, lock-in period of this asset is 3 years. If within 3 years, 3 years from the date of its acquisition, or 3 years from the date of its construction, building or land purchased, so date of purchase, date of acquisition, building, construction, so date of completion of construction. So whenever this new asset has been acquired, from the date of its acquisition, Whenever the new asset is constructed, from the date of its construction for the next 3 years, you are not supposed to transfer. Yes or no? If you transfer this, what will happen? Its cost which you have claimed as exempt under section 54D, yes or no, to that extent the cost will be reduced. The capital gain will be, exemption will be revoked. Understanding? Will you remember this? 54D over. Okay. Now only the assets are changing, no? Assets are changing. So what I'll do, see, if I say 54, who is the assessee? Which assessee will get exemption under section 54? Individual or HUF? Tell me 54B. Which assessee will get? Same assessee. Tell me 54D. Which assessee will get? Any person. Getting my point? Now, transfer of which capital asset? Come on, tell me. Residential, house property, here urban agricultural land, and here land or building for industrial purpose, and this urban agricultural land for agricultural purpose, used for minimum 2 years, used for minimum 2 years, immediately prior to its transfer or compulsory acquisition, as the case may be. Yes or no? Now by transferring this asset, what type of capital gain? What type of capital gain should arise? LTCG, sir. Here STCG or LTCG, any capital gain can arise. Here also any capital gain can arise. That capital gain can be exempted under section 54, 54B or 54D. Yes or no? Now type of capital asset you have written, type of capital gain. Now investment in which new asset? Which new asset? Come on. Long term gain of RHP has to be invested in new RHP. Short term or long term gain of urban agricultural land should be invested in any agricultural land. It can be rural also, it can be urban also. Done. And the capital gain arising on transfer of land or building for industrial purpose should be invested in same land or building for industrial purpose. Now, investment in how much time? How much time? Come on. If it is purchase, then 1 year backward, 2 years forward. If it is construction, then 3 years forward. Done, no? New residential house property purchase, then 1 year backward, 2 years forward, or 3 years forward. The construction should complete. Here, any agricultural land purchased within 2 years from the date of transfer. Okay. Now, land or building for industrial purpose. If you purchase, then purchase within 2 years forward. No, this was 3 years forward. 3 years forward. And if you are constructing, then 3 years forward. Now this period has to be counted from which date? from the date of transfer in all the cases. But if there was a compulsory acquisition, then this period has to be counted with effect from the date of receipt of compensation and not from the date of transfer. If there was conversion into stock in trade, so this period will be counted from conversion into stock in trade. No, it will be counted from the date of sale of stock in trade. Yes. What if this capital gain is arising on receipt of insurance claim? Then the period should not be counted from the date of damage or destruction. No. Period should not be counted from date of transfer. The period shall be counted from the date of receipt of insurance claim. Getting my point? Everyone? So now investment should be made within this time. Okay. CGD option available or not? CGD account option available or not? Yes. In all the three cases, CGD option is available. Meaning that on or before the due date of filing your ROI, you are not able to purchase or construct, as the case may be. Then on or before the due date of filing ROI for the year of capital gain, whatever capital gain is taxable for whatever year, on or before the due date of filing ROI of that year, you should invest in CGD. So whatever amount you have invested in CGD will be exempt under section 54, 54B, 54D, assuming that the amount was invested in new asset. But remember, CGD money you will withdraw, the amount which you will withdraw must be used for purchase or construction of the new asset within the available time. Yes or no? If you are withdrawing and using it for some other purpose, meaning misutilized, so amount misutilized will be deemed capital gain. What if the maximum period given under this sections expire and still CGD account is unutilized, then whatever amount which is remaining unutilized in the CGD account, that amount will be treated as deemed capital gain for the year in which the period of 2 years or 3 years, as the case may be, that period gets expired. Done, sir? So what is the lock-in period? Lock-in period of new asset. Everywhere it is 3 years only, no? So new asset cannot be transferred within 3 years from the date of its acquisition or date of construction, as the case may be. From that date for 3 years, the new asset cannot be transferred. Done, sir? So this was 3 sections. 2 more sections we are supposed to fill in the blanks. Done. So now please pay attention. How will the revocation will be done? If lock-in period, if transferred within lock-in period, then revocation. How will be the revocation done? Cost of acquisition of new asset minus the amount exempted under section 54. Same. Cost of acquisition of the new asset minus the amount exempted under 54B. Cost of acquisition of the new asset minus, now that much cost will be reduced. Now whenever you are going to transfer this within 3 years, that time the capital gain will be calculated. But to calculate the capital gain, this much cost will not be allowed. Cost to the extent allowed under section 54. Will you remember this? Now moving to the next section. 54D is done. Everything whatever I have written here now is about CGD. Copy paste only. Lock-in period 3 years. Within 3 years if you transfer, what will happen? The amount of exemption will be revoked. How it will be revoked? Reduced from cost. Everywhere whatever I have written is that only. Copy paste. Only color has been changed and the section is changed. One section if you learn properly, no, section 54, all the other sections are same only. Only the type of capital gain changes, nature of the asset to be acquired that is changed, and the type of assessee that is getting changed. Rest everything is remaining same only, no? Hello, sir. Now coming to section 54 EC. Which section? 54 EC. 54 EC says which assessee will get the exemption. Under section 54 EC, which assessee will get the exemption? Any person. So what he has to transfer? He has to transfer any immobile property. Any immobile property. Can it be residential house property? Yes, no problem. Can it be urban agricultural land? Yes, no problem. All the three assets which were written in the first three sections, any of those assets can be transferred? Yes. Or any other immobile property can also be transferred? Yes or no? So you can transfer any you can transfer any immobile property. On the transfer of immobile property, long-term capital gain will arise. Which capital gain will arise? Long-term capital gain will arise. That long-term capital gain must be invested in which assets? Must be invested in bonds. Now I am writing the names of the bonds. Bonds of NHAI or RECL or Power Finance Corporation or Indian Railway Finance Corporation, National Highways Authority of India, Rural Electrification Corporation Limited, then Power Finance Corporation and REC. Then IRFC, Indian Railway Finance Corporation. You are supposed to buy the bonds, meaning now the capital gain of your immobile property must be invested in these bonds. If you invest in these bonds, meaning that you have invested the long-term gain of the immobile property. Now within how much time you have to buy these bonds? The time given to purchase this bond, they must be purchased within 6 months. 6 months from the date of transfer of the immobile property. But if the immobile property was compulsorily acquired, converted into stock in trade, damaged, destroyed, then the period of 6 months will be counted from the date of receipt of compensation. 6 months from the date of sale of stock in trade. 6 months from the date of receipt of insurance claim. Getting my point? In every other case, from the date of transfer only 6 months has to be counted. Understanding? Will you get CGD option here? The answer is no. No CGD option is given. If you want to invest in bonds only, then directly invest in the bonds. No. What is the reason for first depositing the money in CGD account, then withdrawing from there, then buying the bonds? If it would have been other asset, then we can understand the CGD option should be given. But if it is bonds only, you want to buy the bonds only, the same bonds only you want to buy, so buy it directly. No. Why are you asking for CGD option? CGD option should not be given. And see, no, period is also 6 months. Period is not that, big. So buy within 6 months. Only one option. No CGD option is given. Now wait. Do you remember new residential house property? New residential house property purchased or constructed. The maximum amount was 10 CR. Do you remember? There was no such maximum amount in other two categories. Here also, the maximum amount which is to be invested in the purchase of bonds cannot be more than 50 lakhs. Cannot be more than 50 lakhs. Understanding? 50 lakhs in a year? No, 50 lakhs in these 6 months taken together. Now what can happen? See, I'll tell you. I'll tell you what can happen. See, if this is your previous year, 24, 25. This is 19th of June 2024. Immobile property transferred. Getting my point? Now pay attention, huh? You have to invest within 6 months from the date of this transfer. So if you will start counting the date of transfer, it will be June to July, August, September, October, November and December. Can I say 19th December 2024? Within this 6 months time, investment in bonds should happen. And that investment cannot be more than 50 lakhs in a year. They had written this. In a year, the investment cannot be more than 50 lakhs also. So you said, okay, first I have to invest within 6 months. I have to invest within 6 months, and the amount invested in these 6 months in a year cannot be more than 50. Right? No? Now pay attention. What the assessee will do, Now he will not transfer on 19 June. No. He will not transfer in 19 June. He will transfer on 19 December. 19 December if the asset is transferred. So I will have to now calculate the 6 months from 19th of December. So December to Jan, Feb, March. The year is over. April, May, June. So can I say 19 June 2025, 6 months period? 6 months period, yes or no? Now can you see out of this 6 months period, some period falls in this year and some period falls in this year. What you will do now? You will invest 50 lakhs here and you will invest 50 lakhs here. Within 6 months, in a year, not more than 50. Within 6 months, investment is 50. Within 6 months, in a year, and within 6 months, in a year. So assessees used to take the deduction up to 1 CR. And the government never intended to give you the exemption for more than 50 lakhs. Government always wanted to give you the exemption of 50. But there was some mistake in drafting the language. And because of that language drafting mistake, what happened? The assessees were able to claim this much amount. In a year, you are saying that I cannot invest in bonds more than 50 lakhs. No. So I'm not investing more than 50 lakhs in a year. And my entire investment is happening in 6 months also. So this was a loophole. So what they did, they said that whatever investment which is happening in the bonds should be made within 6 months. Purchase of the bonds should be made within 6 months. And even if that 6 months is coming in 1 year or spread in 2 years. So the year of transfer, 6 months can end in the year of transfer also. And the 6 months can be spread in the year of transfer and the immediately following previous year also. Yes or no? So they said that the maximum 50 lakhs, what did I say? Maximum 50 lakhs investment should happen within 6 months. In the year of transfer as well as in the immediate following previous year, both taken together, the investment cannot be more than 50 lakhs. Getting my point? So now you were claiming that this 50, 1 CR should be allowed? No, 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 no. Maximum investment 50 lakhs will qualify out of this also. Even if in a year 50 lakh, more than 50 lakh investment is not done, but in that year of transfer as well as in the immediately following previous year, whatever investment is made within these 6 months cannot be more than 50 lakhs. Now, if it is more than 50, any excess over and above 50 will be ignored. Only 50 lakh investment in the bonds will be considered. Yes or no? So your immobile property long-term gain, your immobile properties long-term gain has to be invested within this 6 months in the bonds. Bonds of NHAI, bonds of RECL, bonds of Power Finance Corporation, bonds of IRFC. If any of these bonds you are buying within these 6 months, then whatever amount which you have invested, whatever amount you have incurred to purchase them, their purchase cost is met out of the long-term gain of immobile property, and accordingly the long-term gain of immobile property will be exempted to the extent of investment. But the investment cannot be more than 50 lakhs. Hence the exemption will never go beyond 50 lakhs. Because even if your capital gain, long-term capital gain was 5 crores. So you plan to invest 5 crores, invest. But only 50 lakhs will be considered. 5 crores or 50 lakhs, whichever is lower. 50 lakhs. Rest 4 crore 50 lakh will be taxable. Investment, your long-term capital gain was 75 lakhs. Investment made 60 lakhs. Still 60 will not be considered. Only 50 will be considered. So 50 lakhs or 75 lakhs capital gain, whichever is lower, 50 lakhs will be exempt and the balance 25 lakhs will be taxable. Even if you have invested, what did I say? Even if you have invested 60, but still that 60 will not be counted because that 60 is more than 50. Understanding? Now wait. Pay attention. Will you get any CGD benefit? No. Now what is the lock-in period? For all the new assets in the earlier sections, the lock-in period was 3 years. But in this case, the lock-in period of bonds is 5 years. Meaning that within 5 years, can you sell the bonds? Can you transfer the bonds? No. Otherwise, the capital gain exemption under section 54 EC will be revoked. Yes or no? Wait. Not just transferring within 5 years. But if within 5 years you have kept the bonds as a security and taken a loan, then also the exemption will be revoked. If within 5 years the bonds are redeemed also, meaning converted into money also, then also the exemption will be revoked. So there are 3 reasons for revocation, not just transfer, but transfer within 5 years, keeping the security as keeping a security to obtain a loan, and third, conversion into money, meaning redemption, should not happen within this 5 years. If any of these defaults is committed within 5 years, then your capital gain exempted under section 54 EC, that exemption will be revoked. How it will be revoked, sir? Reduced from cost? No. Here the revocation is very easy. Whatever capital gain which was exempt, invested in the bonds which you are selling in 5 years, the bonds which you are keeping as security and obtaining a loan, the bonds which you are getting converted into money within 5 years, in this bonds, whatever amount of capital gain invested got exempted, no? So ultimately the cost of these bonds which are sold within 5 years or converted into money within 5 years or kept as a security within 5 years to obtain a loan, whatever is the cost of these bonds are there, take that entire cost which was exempted under section 54 EC, that entire cost which was exempted under section 54 EC will now be treated as your deemed LTCG for the year in which that default is committed. What default? Transferred, kept as a security to obtain a loan, or converted into money, meaning redeemed. So these are the defaults. Whatever year this any of this default will be made, then in that year whatever amount of capital gain which was exempted under section 54 EC on such bonds, that amount will be treated as your deemed LTCG of the year of default. So here no need to reduce from cost of acquisition minus 54 EC. No need to do this. Entire 54 EC will be treated as deemed LTCG in the year of default. Will you remember? Now there is one small question should I ask you. Is it an immobile property? Can I claim exemption under section 54 for this LTCG? To get this exemption, I have to invest in residential property. So whatever investment made in the residential property within the available time, yes or no? Whatever investment made in the residential property, that investment is out of this long-term gain. Accordingly, this long-term gain can be exempted under section 54. Hello? Can I claim this LTCG as exempt under section 54 EC? The answer is yes. So it is not necessary that the LTCG which you are exempting under section 54 cannot be exempted under 54 EC. It can be exempted under 54 EC also. Now you have to decide under which section you want to claim. If you want to claim the exemption under section 54, then acquire residential property. If you want to claim the exemption under 54 EC, then acquire bonds. Understanding? Sir, but I have acquired both. So can I take both 54 as well as 54 EC? The answer is yes. For some part of your long-term gain which you have invested in residential property, you can claim 54. And for the balance part of your long-term gain which you have invested in bonds, you can claim 54 EC also. Take the exemption is the best in the best advantageous manner possible. So first take the exemption under 54, then whatever capital gain remains, you can claim it under section 54 EC also. But first claim 54, then whatever balance remains, claim under 54 EC. Don't claim 54 EC first. Claim 54. Then whatever capital gain remains, invested in bonds, can be exempted under section 54 EC. Understanding? Why specific section first, Because if you will claim this 54 EC first, your capital gain amount will come down. For example, your long-term capital gain, this amount was 80 lakhs. 80 lakhs, okay, no? Now you have invested in new RHP. New residential house property you have acquired 50 lakhs. And bonds you have acquired, notified bonds you have acquired 40 lakhs. Getting my point? So can I say, if you take 50 as exempt, then 30 will remain. Hello sir. Then out of that 30, 40 is invested, 40 investment is done. So 40 investment, this 30 entirely invested. So 30 can be exempted under 54 EC. Still 10 lakh worth of bonds will remain. Getting my point? So how much was the capital gain? First tell me. How much was the capital gain? Long-term capital gain 80. Out of this you claim section 54 first. So 50 lakhs or 80 lakhs, whichever is lower. Can I say 50 lakhs can be exempt under section 54? How much capital gain will remain? 30. Now this 30 lakh can be exempted under section 54 EC also. So 54 EC, how much bonds? How much bonds you have acquired? 40 lakhs, no? Can the entire 40 lakhs be exempted? No, your capital gain is only 30. So out of 30, 30 can be exempted, no? Even if you have made the investment more than 30, meaning that your entire remaining long-term gain is invested, no? So claim this 30 only as exempt. So under section 54 EC, even if your investment in bonds is 40, but still you can claim 30 only, no? So claim 30. How much capital gain taxable? Nil. But don't you think if investment in bonds was 40, exemption was not 40, only 30. So can I say 10 lakh worth of bond still remains? This can be exempted from any other long-term gain of any other immobile property. This can be exempted. Got it? But reverse is not possible. Reverse is not possible means? Now let's reverse this. First claim 54. 54 EC, then claim 54. So out of 80 lakhs, if I claim 54 EC first, so 40 lakhs or 80 lakhs, whichever is lower, I will be able to claim entire 40 lakhs from here. How much capital gain will remain? 40. Now this 40 or 50, whichever is lower, 40 only, no? So now under section 54, only 40 will be allowed as a exemption. How much will be taxable? Nil. Here also nil taxable, here also nil taxable. No problem, sir. But don't you think now 10 lakh of cost of the new residential house property still remains, which I could not claim as exempt? Tell me yes. Now that cannot be claimed out of the capital gain, long-term capital gain of any other immobile property. That will be wasted. But if 10 lakh is remaining out of the bonds, no, that can be exempted from any other long-term capital gain of any other immobile property also. Getting my point, sir? So first specific exemption. Which exemption? First claim 54, then claim 54 EC. First claim 54B, then claim 54 EC. First claim 54D, then remaining 54 EC. Because if any investment out of 54 EC could not be claimed, hello, then it could be claimed from the long-term gain of any other property also. Understood? Residential house property, 2 residential house property, 54. Whatever long-term gain remains can be claimed under 54 EC. And if the investment in bonds was more than the available gain, that excess amount invested can be claimed as exemption from the long-term gain of any other asset also, no? Any other immobile property also, no? 54B. Urban agricultural land capital gain invested in any other agricultural land. Claim that amount first exempt. Now whatever capital gain which remains, no, after claiming 54B exemption can be claimed under 54 EC. If the investment in bond was more than available capital gain, then to the extent of gain, amount will be exempt, but excess amount remaining invested in the bonds can be claimed as exempt from long-term gain of other immobile property also. But the reverse is not possible. Getting my point? Hence claim the specific exemption first, then whatever long-term gain remains, that you can claim under section 54 EC. Got it? So can you claim both the exemptions together? Yes, you can. But first claim the specific one, then later on claim 54 EC. Sure, sir. Should I move ahead, sir? 54 EC. This part. Entire part I have done. purchase, deposit not applicable, CGD deposit not applicable, how much amount to be invested in the bonds, what is the lock-in period of the bonds, then what happens if there was some default in the bonds. I have already explained you all these things. Will you be able to remember this? Yes. And will you be able to apply the concept in the question? Let's see. Come to question number 11. We have done no last time. 11th question we have done. Or it is yet to be done. Done, sir, done. Illustration number 12. Long-term capital gain of 75 lakhs arising from transfer of building, meaning an immobile property is transferred. On the transfer of that immobile property, long-term capital gain is 75 lakhs. And this long-term capital gain is arising from the transfer of the building, and the building was transferred on 1st of May 2024. So from 1st of May 2024, this is the date of transfer. From that date, we are supposed to count 6 months. Okay. So what are 6 months? 1st November 2024. 1st May to 1st November. Okay. Now, okay, so the building will be transferred. Building is transferred on 1st May. The long-term capital gain on transfer of this building will be exempt if such capital gain is invested in the bonds redeemable after 5 years issued by NHAI. Examine the reasons whether the given statement is true or false. False. It cannot be exempted fully. If the long-term gain is invested in the bonds, it can be claimed as exempt under section 54 EC, but it cannot be claimed entirely exempt. Getting my point? It can be exempt up to the limit of maximum 50 lakhs, because the investment in the bonds of NHAI, even if the entire gain is invested, still the benefit will be available to the extent of 50 lakhs only, because any bonds purchased over and above 50 lakhs, that will be ignored. Yes or no? So this was your illustration number 12. Whatever I have discussed, you will find it here. Okay. Now let's move on to the next question. Question number 13 we are going to do in the end. Last question will be this, and the syllabus will be over. Okay. That we are going to do at the end. First question will be the second last question. 2, 3, 4 done. Come to question number 5. Ready? Okay. Mr. Sarthak entered into an agreement with Jai Kumar to sell his residential house located at Kanpur on 16th August 2024 for 1 crore 50 lakhs. So, can I say this is the date of sale agreement, date on which the sale agreement is entered, 1 crore 50 lakhs. As on that day, the sale price is 1 crore 50 lakhs. Okay. Okay. Now the sale proceeds is to be paid in the following manner. So both of them agreed that 20% will be paid through account pay check on the date of agreement. So as on the date of sale agreement, 20% sale consideration is paid by way of account pay check, prescribed modes. So now there will be stamp duty value given. Stamp duty value as on the date of sale agreement, stamp duty value as on the date of registration, and one more stamp duty value will be given. 3 stamp duty values are given. Out of the 3 stamp duty values, you will ignore all the stamp duty values, but you will take the stamp duty value as on the date of sale agreement, because as on that day, the consideration or any part thereof is paid by way of prescribed modes. So, can you see 3 stamp duty values given? One on 16th of August, another on 15th of December and 14th of January. 15th December, what is happening? See, 60% on the date of possession of the property. So the possession will be given on 15th of December. And the balance on the completion of registration of title. So the title will be registered, means the sale agreement will be registered. The property will be registered on the name of the buyer on some other day, meaning in the month of January. Okay, no? So Jai Kumar handed over the possession of the property on 15th of December. This is the date on which the possession was given. And registration took place on 14th of January. Getting my point? So 3 dates are there, one by one. First date is DOSA, date of sale agreement. Second date is date of possession. Third is date of registration. As on the date of registration, the property is finally transferred. So actual date of transfer is date of registration only. Yes or no? Date of sale agreement, date of possession and date of registration. See, the sale consideration is 1 crore 50 lakhs. This is 15th of November 2024. 15th November, 16th of August, sorry, 16th of August. This is 15th of December 24. This is 14th January, no? 14th of January 2025. As on the date of sale agreement, no? 20% of this will be paid. And by way of account pay check. As on 15th of December, date of possession, how much is to be paid? 60%. So how much is the balance? 20% when the registration will be done on the name of the buyer. Now 20% of this will be 30 lakhs. 30 only, no? This also 30 lakhs. And this will be 90 lakhs. So the entire sale consideration is paid in these installments. Now see, as on the date of sale agreement, the stamp duty value was, what was the stamp duty value? Come on, tell me. Stamp duty value. 1 crore 71 lakhs, no? 1 crore 70. 71 and 7150. Now tell me, stamp duty values are higher than the sale consideration. Stamp duty values are higher than the sale consideration. Can you check all the 3 stamp duty values? But we have to check, we have to take any one stamp duty value. Which one should I compare with the sale consideration? With the sale consideration, I will compare this one. DOSA. I will not compare this one. I will not compare this one. Why? Because as on the date of sale agreement, the consideration or any part thereof is paid by way of account pay check. Then as on the date of sale agreement, whatever stamp duty value was there, I can consider for the purpose of section 50C. Other stamp duty values I will ignore. So now tell me, can I say my stamp duty value, which is 1 crore 70 lakhs, is higher than sale consideration of 1 crore 50 lakhs? Yes sir, it is higher only. And can you check the difference? Difference is equal to 20 lakhs. And this difference is also higher than 10% of sale consideration, which is 15 lakhs. Difference is higher than 15 lakhs, no? Therefore, 50C will be applicable. And if 50C is applicable, then FVC is equal to sale consideration is equal to 1 crore 50 lakhs. Cannot be taken. My FVC will be stamp duty value, which is 1 crore 70 lakhs. So now the first amount to calculate the capital gain is full value of consideration. See how complicated they are making the things. But actually the things are not complicated. We have learnt everything. But the way in which they are presenting in the question, no, they are, using the language. From that language, it becomes so complicated. It becomes so difficult. But it is not actually difficult. Did you understand this much? Sure? Okay. Now, FVC we have taken. Mr. Sarthak had acquired the residential house on 1st April 2001. Oh, for 30 lakhs. So this was 30 lakhs was the cost of acquisition. Yes or no? And then after recovering the sale proceeds from Jai Kumar, he purchased two residential house properties, one in Kanpur for 20 lakhs on 24th March 2024 and another in Delhi for 35 lakhs. Okay. Compute the income chargeable under the head capital gains for Mr. Sarthak for the assessment year 25-26. CII also given. But CIIs I will not use. Why? I'll tell you. See. Out of the three dates, no, always the date of registration is treated as what? Date of transfer. This is the date of transfer. So can I say the date of transfer is on or after 23rd July 2024? So cost will be reduced with indexation or without indexation? Without indexation. So in order to calculate my capital gain, do I have full value of consideration? Yes, sir, I have. Now less what? Less transfer expenses, that is nil. So my net consideration will be how much? 1 crore 70 lakhs. No transfer expense, no guys. So I will now reduce less cost of acquisition, which was 30 lakhs only. So I will get long-term capital gain only. Sir, why did you calculate long-term capital gain? Because the property was acquired on 1st April 2001. From that date till 14th of January 2025, this was the period of holding, which is greater than 24 months. Therefore, capital asset is long-term capital asset, and accordingly the gain is long-term capital gain. No indexation to be allowed, since date of transfer is on or after 23rd July 24. Hence my long-term capital gain will be 1 crore 40 lakhs. Did you understand this much? Tell me yes or no. Now out of this long-term capital gain of residential property, I can claim the exemption under section 54, provided investment is made in new residential property. So I have acquired two residential properties, one in Kanpur and one in Delhi. Yes or no? And don't you think I have the option to invest in two residential house properties and take the capital gain as exempt. Why? Because my long-term gain is not more than 2 crores. So I have the option to invest in 2 properties and claim the capital gain as exempt. Yes or no? So both the properties investment I can consider, provided both the investments are made within the given time. So I will have to see that what was my date of transfer, 14 January. 1 year backward, 2 years forward from this for purchase. 1 year backward, 2 years forward. So can I say any purchases made between 14th January 2024 to 14th January 2027, any purchases made will qualify for section 54? So can I say the investment in Kanpur property was made on 23rd March 2025 only, and investment in Delhi property was made on 28th May 2025, meaning have I invested within the time? Yes. And even before the due date of filing my ROI, I have invested in both the properties. So in this return of income which I am going to file for this year, will I be able to claim section 54 exemption? Yes. By investing in both these properties, I can claim the exemption, because 2 properties investment can be claimed as exempt under section 54 if the amount of long-term gain is less than or equal to 2 crores. In my case, it is less than equal to 2 crores, 1 crore 40 lakhs only. So I can invest my entire long-term gain in 2 properties like this. Hello, sir. So what will happen here? Come on. LTCG. This was your gross LTCG. I'll write it gross LTCG. Now out of this I will reduce exemption under section 54. That will be A, gross LTCG, which is 1 crore 40 lakhs only, or B, which is investment in purchase of Kanpur property and Delhi property. What was the Kanpur property cost? It was 20 lakhs and Delhi is 35. 20 lakhs and Delhi is 35 lakhs. Total is 55 lakhs. So 140 or 50, whichever is lower. Whichever is lower, come on, tell me. 55 is lower, no? So can I say out of 1 crore 40, 55 lakhs will be exempt? And how much will be taxable now? 85. Taxable 85. Very good. If he would have acquired one more property, then he has acquired 3 properties. Any 2 having highest investment value, having highest cost, could have been considered. If he would have acquired one property in Kanpur and another property in Colombo, property must be acquired in India. So automatically the property which is acquired outside India will disqualify. Getting my point? But since both the properties are acquired in India, investment in both the properties can be counted. Why both? Because the amount of capital gain is not more than 2 crores. So this is your taxable LTCG under section 112, and on this we charge tax at the rate of 12.5%. 12.5% without indexation. Hello? But can you calculate with indexation also? Absolutely yes. Because the property was acquired prior to 23rd July and transferred on or after 23rd July. So you will get the option to calculate the tax on the long term gain with indexation at the rate of 20%. You will get that option also. So first what we'll do, we'll calculate 12.5% of this. Calculate. So this is my long term capital gain. Now tax at the rate of 12.5% on LTCG without indexation. So 12.5% of 85 lakhs will give me how much, sir? 1 lakhs 10 lakh 62,500. 10 lakh 62,500. Now I have the option to pay tax at the rate of 20% also on LTCG with indexation. So now I will have to recompute the long term gain. What I'll do, I'll just calculate the cost. I'll just index the cost. Rest everything remaining same only. So from start till end, everything will remain same, including the exemptions and all. Getting my point? But the cost will be indexed. Done? You actually index the cost. Why? To compute the capital gain computation will not be index. That will be without indexation only. But only to calculate the tax liability, you are going to calculate the capital gain with indexation. Yes or no? So now, what will be the long term gain with indexation that we are going to first calculate? Okay. Can I take the net consideration of 1 crore 70? Yes. Minus index cost 30 lakhs into 363 divided by 100. 30 lakhs into 363 divided by 100. What is the index cost? 1089,0000. 1 crore 8 lakh 90,000. 1 crore 8 lakh 90,000. Everyone got this? So what will be the gross LTCG? Come on, tell me. It will be 68 lakh something. 68 lakh 10,000. 61 lakh 10,000. 61 lakh 10,000. Now out of this, I'll take the exemption. What was my exemption? Under section 54. What was the exemption? Come on, tell me. It was 55 lakhs, no? So take the exemption of 55 lakhs. How much remaining? Tell me. It will be 6 lakh 10,000 only. And on this, 20% I have to apply. Apply 20%. $122. Now they are telling you to pay tax. Either you pay 122 or you pay 10 lakh 62,500. Which one would you prefer? Definitely 1,22,000, no? Therefore, tax on LTCG under section 112 lower of above two taxes, which is 1,22,000. Now with this tax, the tax on your other income will also be added. Then there will be surcharge or there will be rebate, tax including surcharge, tax after rebate. Then on that 4% will be applied. All those things we are supposed to do. Okay, no? But those things are not given. I'll just calculate this tax. That's it. Have they told you to calculate this tax? See the required part of the question. Have they told you to calculate the tax or just calculate the capital gain? Yes. So your answer actually has to stop here. Okay, no? But why we have done? In that same question, they can give you calculate the tax also. then your calculation should be like this. Sure, sir? Should I move ahead? Very good, sir. What if the date of transfer was prior to? What if the date of transfer was prior to 23rd July? Then the cost must be indexed. Your capital gain computation would not have been 85 lakhs. It would have been how much? 61 lakh 10,000. And out of that, you would have taken the exemption 55 lakhs. Your final capital gain would have been 6 lakh 10,000 only. On that, you would have paid 20% directly, since you transferred the asset prior to 23rd July only. Then all this discussion was not required also. Getting my point? Okay. Question was good question, no? Now come to the next question. Mark the above question important, the question number 4. Mark that question number 5 which we have done just now. Mark this question important and mark this question also important. Question number 6. Very good question. Okay. Mrs. Yuvika bought a vacant land for 80 lakhs in May 2005. 80 lakhs is the cost of acquisition. May 2005 is the date of acquisition. Registration and other expenses were 10% of the cost of land. So what was the cost of land? 80. 10% of that, 8 lakhs. So 80 plus 8 lakh is 88 lakhs. That is actual cost of the land. Yes or no? So actual cost, I'll write down here. Actual cost. How much is actual cost, sir? 80 lakhs plus 8 lakhs. 8 lakh means 10%. Yes or no? That will be 88 lakhs. Next one. She constructed a residential building on the said land for 100 lakhs during the financial year. Wait, one moment. Only 1 minute. Only 1 minute. This is what is happening. See. He acquired a land. She acquired a land in May 2005 for 80 lakh. 10% was the additional cost. Okay, no? So total cost of acquisition is actual cost 88 lakh. Can I say this is the cost of the land? And on this land, a building was constructed. Residential house was constructed. So the construction of the residential house completed in 2007-8. And the cost of construction was 1 lakh is nothing but the cost of that residential house. Okay, no? Now I have land and building. Land date of acquisition is different. Building date of acquisition is different. Okay. Now this land and building, what is happening? In 2015, April 2015, she's trying to sell. And sale consideration was fixed at 700 lakhs. And in April 15, 700 lakhs was the sale consideration. On 23rd April 2015, she is receiving 20 lakh rupees as advance in cash from the buyer. But the buyer could not pay the balance amount. So this 20 lakh which she received as advance, she forfeited. Do you remember any advance money received and forfeited in the course of negotiations for transfer of a capital asset, but the negotiations did not result into actual transfer? That advance money, if received and forfeited on or after 1st April 2014, then it was already taxed under the head IFOS. On or after 1st April 2014, received and forfeited, taxed under the head IFOS. No need to adjust under section 51. So even though this advance money is received and forfeited, I will not adjust out of the cost of Yuvika. Hello? Because it was received on or after 1st April 2014. That is something which I have written. April 15, meaning on or after 1st April 2014, advance received and forfeited how much? 20 lakhs. And this is not to be adjusted under section 51 because this was already taxed in 1516 under the head IFOS. Forget about this now. What is happening now? Now, Mrs. Yuvika again entered into an agreement on 1st of May 2024. This is the date of sale agreement, DOSA, for sale of this house at 810 lakhs, meaning this is the sale consideration, 810 lakhs. She received 80 lakhs as advance by RTGS. So as on the date of sale agreement, she is receiving some part of the sale consideration, meaning 80 lakhs, in the form of prescribed modes. Hence, any stamp duty value as on the date of sale agreement will be considered for section 50C. Yes or no? So what is happening? The stamp duty value on the date of sale agreement was 890 lakhs. This I will consider. The sale deed was executed and registered on 14th of July 2024. So actual transfer happened on 14th of July 24 only. Hello sir. Because the sale agreement was registered on 14th July. But the stamp duty value as on 14th July 2024, I will not take that because that is 900 lakhs. Can you see? So 900 lakh rupees of what? Stamp duty value I will have to ignore because I am going to take 890 lakhs. That is the stamp duty value as on the date of sale agreement. Yes or no? Now, Mrs. Yuvika paid 1% as brokerage. Okay. And now, what are the acquisitions and investments that we are going to see? But first, we'll calculate the capital gain based on this information. Everyone. So now, here, sale agreement entered. Sale agreement entered on 1st May 24. As on that day, the stamp duty value was 890 lakhs. And as on the date of sale agreement, out of the 810 lakh rupees of sale consideration, 80 lakh was received by way of prescribed modes. So this stamp duty value I will consider. As on the date of registration, the stamp duty value is given. I will not consider this. Okay. And what was the sale consideration? 8 lakh 10. 1% of that is paid as brokerage. Entire question, see, I have taken all the information. Now based on this information only, I am supposed to solve. So tell me, will I take the full value of consideration? Yes. How much? 810 lakh is the sale consideration. I will take this or stamp duty value. Stamp duty value is higher than the sale consideration. By how much? By how much? Only 80 lakhs. Difference is 80 lakhs. Is it more than 10% of 8 lakh 10,000? The answer is no. If it would have been more than the difference between sale consideration and the stamp duty value, this difference is how much? 80 lakhs. If this difference would have been more than 10% of sale consideration, only then 50C will be applicable. Only then the stamp duty value will be taken as full value of consideration. Otherwise, I have to take the sale consideration only. Yes or no? So here 50C will apply or will not apply? Will not apply only. So I cannot take the stamp duty value. I guess you might have committed mistake over here only. No mistake? You have taken 810 only? Excellent. Very good. See, this difference is not more than 10%. Hence 50C not applicable. Full value of consideration is sale consideration only. 810. Now 10% of sale consideration, 1% of sale consideration is brokerage. That is transfer expense. So net consideration I will have. Now out of this net consideration, will I reduce cost or index cost? Index cost. Why? Because see, date of transfer I have to check. Date of transfer is always the date of registration. Can I say date of registration is 14th July? That is the date of transfer prior to 23rd July only. Hello sir. So if prior to 23rd July is there, what I will do? I will do the indexation of the cost. And for that, cost of land was 88 lakhs. Multiplied by CII of transfer year 363 divided by CII of acquisition year 2005-6. Hello. CII of 2005-6 will come, no? 2005-6 CII. Okay. So I will get 88 lakh into 363 divided by 117. I will get this much. This is my index cost of acquisition. Now I will reduce the index cost of acquisition of the building also, no? Because land and building both are transferred. So building's cost of acquisition was 1 crore into transfer year CI divided by CI of 7-8. See, building was constructed in 7-8. Getting my point? 7-8 to 24-25. So this will give me the index cost of acquisition of building. So from this entire net consideration, I will reduce both the index costs. Are you all getting these amounts? Have you calculated properly? Now my gross long term gain will be 2 crore 47 lakh 47,901. 247,47,901. 247,47,901. This is my gross long term gain. So can I say this is the gross long term capital gain on sale of residential house only? Residential house along with building. So this is nothing but the sale of residential house, long term gain on sale of residential house. Can it be invested in another residential house? Yes. How many residential houses I can buy? If the long term capital gain, this amount would have been less than or equal to 2 crore, then 2 houses, otherwise only 1. So is this amount less than equal to 2 crores? No sir. This is more than 2 crores. So now I will have to consider the investment in only one residential house property. Yes or no? Now can you see the assessee has invested in 3 residential houses? Tell me yes or no. First residential house he acquired in Delhi and second in Chandigarh for 130 lakhs and 50 lakhs. Okay. On 31st January and 15th of May. Both the investments, both the dates are within 2 years after the date of transfer. 14th July 2024. After 14th of July, within 2 years, the new residential house should be acquired. So these 2 residential houses are acquired within those 2 years, even before my return filing due date. Yes or no? So investment in both the houses eligible. But I cannot take both the houses investment exempt for section 54. I will have to take only one. See, one more house was acquired. But was that acquired in India? No. That was acquired in Uttarakhand, no? UK means Uttarakhand, no? No. United Kingdom. Hello. So how much? Tell me. How much was invested in this house? 180. This can never qualify for 54 because the investment made outside India. In a residential property outside India. This investment cannot allow me to take section 54 exemption. Yes or no? So I can invest in residential house property in India. So I have acquired 2 residential house properties in India. But both the investments cannot qualify. Only one. Which one would I prefer? The higher one or lower one? Higher one. So definitely I will consider the investment made in Delhi house property which is 130 lakhs. And Chandigarh I will ignore. Hello sir. So out of the 3 investments made in the residential house, only one investment can be counted. Outside India, forget. In India, consider. But out of those 2, only one. That is 130. Can I say this amount can be exempted under section 54? So how much was my long-term capital gain? 247,47,901. Yes or no? Either that amount or the amount invested in new residential house, 1 crore 30. Whichever is lower, I will get 1 crore 30 as exempt under section 54. So though my balance long-term gain will be this much. Now can I say you have acquired the bonds also, NHAI bonds? Approved under 50 for 50 lakhs on 30th November 24 and 40 lakhs on 9 January 25. Wow. See, from 14th July, if you count 6 months, 14th July was the date of transfer of your immovable property. From that day, you have to count 6 months. 14th July to 14th August, September, October, November, December and January. Till 14th of January, whatever investment made can qualify. But that investment in the bonds cannot be more than 50 lakhs. So can I say this entire investment of 50 and 40, 90 lakhs is made within 6 months only. But that 90 cannot be fully qualifying, because any investment in the bonds over and above 50 lakhs within 6 months also over and above 50 lakhs will be ignored. So how much was my capital gain, guys? This much was remaining. So this I can exempt provided this was invested in bonds. So was it invested in bonds within 6 months? Yes, it was invested in bonds in 6 months, but the investment was 90. So out of that 90 invested, but 90 will not qualify, only 50 will qualify. So 90 or 50, whichever is lower, 50. 50 or capital gain, whichever is lower, 50. Yes or no? So out of my capital gains, 50 lakhs will be exempt. And what will be taxable? 6747,901. And this long-term capital gain is arising on transfer. This is a taxable long-term capital gain arising on transfer of a residential house on or prior to 23rd July. On this entire amount I will have to pay 20%, because I have done the indexation also, and this is the long-term capital gain calculated after taking indexation. On this I have to pay 20% only. Will you remember this? Very easy question. Very, very, very easy question. Got it, sir? Should we move ahead? Very good, sir. So now only one question remains from test your knowledge. All the other questions are done. Only question number 1 remains. Yes or no? And question number 13 remains from illustrations. Now do you remember one question more we have solved? Harshita. Here only. See, question number 3. Question number 3. We solved this question till here only. And I told you not to read this balance part. Now please do the needful. We have to read this part also. Okay. She invested 50 lakhs in the bonds issued by National Highways Authority of India on 31st March 2025 and another 50 lakhs in the bonds of RECL in April 25. Compute the amount of capital gain and business income in the hands of Harshita arising from the above transaction, indicating clearly the reason for treatment of each item. Pay attention, huh? See, you had land, do you remember? Which you converted into stock in trade. On this land, which is your stock in trade, you constructed some flats. Now the land along with the flats is sold. Conversion is a transfer. Conversion is transfer. But on conversion, the gain will not be taxable. The gain will be taxable as on the date. Gain will be taxable in the year in which the stock in trade is sold. So the stock in trade is sold. Stock in trade is sold in the month of March 25. So both your PGBP income as well as capital gain will be taxable in 24-25 only, because the stock in trade is sold in March 25. So in the case of conversion, whatever gain which was arising under section 45(2) will be taxable in the year in which the stock in trade is sold. Okay, now, so now this long-term capital gain on what? Land, meaning an immobile property computed under section 45(2) will be taxable in the year of conversion. Year of transfer? No, will be taxable in the year of sale of stock in trade. So if this long-term capital gain under section 45(2), which is taxed in the year in which the stock in trade is sold, can it be exempt under section 54 EC? Yes. But for that, you need to invest in bonds. Bonds of NHAI, RECL, PFC, etc. Yes or no? But those bonds must be acquired within 6 months from the date of transfer. No? Date of transfer. No? Or date of sale of stock in trade. Yes. Because this is the date based on which your capital gain is taxed. No? Your capital gain will be taxed in the year in which the stock in trade is sold. So definitely the investment should be made in the new asset, in the bonds, within 6 months from the date of sale of stock in trade only, no? So 6 months from this you have to count. March 25, full month you count. Assuming that 1st March was the date of sale. Okay, no? So March, April, May, June, July and August. March, April, May, June, July, August. 6 months are there. So starting from March to August 2025, these are the 6 months. Within these 6 months, the investment should happen in the bonds. Some investment happened here in 24-25. How much? 50 lakhs. Some investment happened here in previous year 25-26, 50 lakhs. You see in the question, some 50 lakhs investment made in March 25 and another 50 lakh investment made in April 25. Both the investments are made within 6 months only from the date of transfer, no, date of sale of stock in trade. Because this is the date on the basis of which your capital gain is getting taxed in this year, no? So if your capital gain is getting taxed in this year based on this date, so investment in the bonds should be made within 6 months from this date only, no? Hello, sir. So what will you do now? Come on, tell me. Total investment made is 1 CR within 6 months. Cannot be more than 50 lakhs. So the amount invested in bonds, is it more than 50 lakhs within these 6 months? Yes or no? Will not be counted over and above 50. Ignore. So how much investment will be counted? Only 50. So either the amount of long-term gain which is getting taxed right now. How much was the long-term gain which was getting taxed right now? You must have calculated when you have calculated this question. Come on, tell me. How much was the capital gain? 1022 something something. No, 68,14,159 was the long-term capital gain to be taxed when those 5 flats are sold. 1022 something something was there. Yes, 1022 1239. 1022 1239. This was the long-term capital gain under section 45(2) on transfer of what? This is the long-term capital gain on transfer of land. Transfer of land means conversion of land. On conversion of land into stock in trade. Okay, no? Long-term land into stock in trade. So this is the long-term gain. Long-term gain on conversion of land into stock in trade calculated under 45(2). This is getting taxed right now because this is getting sold as stock right now. This much land is getting sold as stock in trade right now. Getting my point? So out of this only, now I will take exemption under section 54 EC. How much exemption? Either the amount of capital gain or amount invested, which cannot be more than 50 lakhs. So this is A, this is B. B is this or this, whichever is lower. So 50 lakhs will be taken. 50 or this, whichever is lower. So tell me, 50 lakhs will be taken as exemption, no? So how much is the capital gain taxable? 52,21,239. This is taxable LTCG. Please check the answer. Textbook. Study mat. Check the answer. Did you understand what happened? Sure. Half part we calculated earlier. There we got the capital gain of 1 crore 22 lakh something something. Hello sir. So out of that long term capital gain, I now want to claim exemption under section 54 EC. Can I claim? Yes, because that was the long term gain on transfer of, on conversion of land. But which was not taxed at the time of conversion. It was taxed in the year of sale of stock in trade, in the year in which it is converted, in the year in which it is sold as stock in trade. So if this year it is getting taxed because in this year it is getting sold as stock in trade. So out of this long term capital gain, can you claim exemption under section 54 EC? Yes. For that you are supposed to invest in bonds within 6 months from the date of transfer. No, date of sale of stock in trade. Because this is a capital gain taxable under 45(2) will be taxable in the year of sale of stock in trade. The date of sale of stock in trade is important. From that date, you are supposed to count the period for investment in new asset. Okay. So what? Only 10 flats are sold then? 10 flats along with the land is sold as stock in trade. But the land was earlier a capital asset, no? So after conversion, it is getting sold as stock in trade. But before conversion, it was a capital asset only, no? So from the date when it was acquired as capital asset till the date of conversion, whatever gain was there, that gain we have calculated under 45(2). But the gain for the entire land we have calculated, entire gain will not be taxed right now because entire land is not sold as stock in trade. Only the land with those 5 flats is, only the land with that 10 flats is sold as what? Stock in trade. You have still not got it. Do you remember this land I made? What you are trying to say? So, okay, entire gain was this much, you are saying, no? This was the total amount of gain. This was the total amount of gain. Out of this, I told you to tell me the total gain of only 10 flats. So you told me this answer, no? This what? So this was your total capital gain or what? Total capital gain. Total capital gain, no. That total is not going to be taxed right now. I am asking how much is the capital gain which is getting taxed right now? Capital gain for the land which is getting sold along with the 10 flats. Only that much capital gain will be taxable, no? Or the entire amount. So I was asking you how much capital gain is taxed right now. This was the total. Hello sir. This was the total capital gain, no? Out of this, how much is for the 10 flats? 1022 1239 into 10 divided by 15. 68 lakh 14,159. Okay. So this will be 68. So I have written the full capital gain, not to worry. Correct. The things are correct only. Everything is correct. But the capital gain for land which is getting transferred as stock in trade right now, only that long term capital gain will be taxable right now, and from that I am claiming the exemption. Yes or no? 68 lakh 14,159. So what about the balance capital gain? Balance capital gain which relates to those 5 flats, those land occupied by 5 flats, that will be taxable later on. And whenever the 5 flats will be sold, that time the balance capital gain will be taxable. So that I am not supposed to consider here. By mistake I took the full amount because I thought that this amount is for 1022 was for how much? 10 flats. But for 10 flats it was not 1022. For 10 flats it was 68 only. This amount is to be considered. Correct. 68 lakh 14,159. Out of this, if I take the exemption of 50, how much will be the taxable capital gain? 18 lakh 14,159. So this will be exemption. This will be 68 lakh 14,159 or 1 crore or 50 lakhs. This or this, whichever is lower, 50. Yes, correct. Now it is correct. Done. So this was your question number 3. The remaining part which we have done. Okay. Now the last section of exemption. If we do this, if we complete this, the exemptions part will be over. Section 54F. Okay. Okay. So 54F says that if you are an individual or HUF, okay, and you have transferred any capital asset, meaning that now you don't have to transfer any specific asset. Now you can transfer any capital asset. Okay. So if you will transfer any capital asset, on transfer of that capital asset, long-term capital gain will arise. What type of gain will arise? Long-term capital gain will arise. So this is a long-term capital gain for transfer of any capital asset other than residential house property. Meaning that other than the residential house property, any capital asset you transfer, you are getting long-term capital gain. Okay. Now, if this long-term capital gain you are getting, this long-term capital gain we can exempt under section 54F. So under section 54F, this will be exempt. If you want to claim exemption, then remember that as on the date of transfer of this capital asset, you should not own more than one residential house property also. First of all, the asset transfer should not be residential house property. And additionally, they are saying that okay, you are transferring any other asset, but as on the date of transfer of that asset, you should not be having more than one residential house properties. Meaning that, can you have no house property? Yes, you cannot have a house property. That is very good. Okay, and as on the date of transfer of this asset, can you have one residential house property? Yes, one house property you can have. But as on the date of transfer of this asset, you have two house properties. Already you are having two house properties. Then forget about this gain to be exempted under section 54F. If you want this gain to be exempted under section 54F, please remember, as on the date of transfer of this capital asset, assessee shall not own more than one residential house. So can I transfer jewelry? Can I transfer jewelry? Yes. Can I transfer shares? Yes. But as on the date of transfer of jewelry, as on the date of transfer of shares, I should not own more than one residential house properties. Okay, so whatever capital gain is there will be exempt under section 54F, but for this, to get this exemption, I have to invest. Where? In another residential house property. Now, where I have to invest? Purchase of one residential house property in India within 1 year backward, 2 years forward, or construction of any one residential house property in India within 3 years forward, or I can deposit the amount in CGD also on or before the due date of filing my ROI. Don't you think that the same investment I had to make to get exemption under section 54 from the long-term capital gain of my residential house? So if my residential house, I transfer that residential house and invest the long-term gain like the same way which is given here, okay, can I get the exemption under section 54 from that long-term gain? Yes. Hence they are saying that you transfer any capital asset other than residential house. Because from the long-term gain of residential house property, if you make this type of investment, you are already going to get section 54 exemption for that. Getting my point? You should not be getting the benefit. What did I say? You should not be getting the benefit twice for the same investment. Once you have taken the exemption under section 54 and now you are taking the exemption under section 54F, that should not happen. So if you are transferring a residential house property and investing in another residential house property, for that you are already getting exemption under section 54, don't come to this section. Hence, other than residential house property, any other capital asset you transfer. And if the net consideration of that asset, did I tell you capital gain? No. I told you if the net consideration of this asset is invested within this time in this manner, then you are going to get what? The exemption under 54F. So far, whatever section we have seen, whatever exemptions we have seen, those sections, those exemptions were available because you were investing your capital gain. Everywhere in all the sections, it was assumed that you are investing your capital gain. If you are investing your capital gain, you are investing your capital gain. But under section 54F, they are clearly saying that the net consideration of this capital asset must be invested like this to get the exemption of long-term gain arising on this capital asset. What did I say? Sir, what did I say? The net consideration of the capital asset should be invested to get the exemption from long-term capital gain. Meaning whatever investment you are making in the new residential house property, purchase of new residential house property, construction of new residential house property, or CGD deposit, whatever investment you are making, we will not say that it is your capital gain which is getting exempted. We will always say that it is your net consideration of the capital asset which is getting invested. If the entire net consideration is invested, entire capital gain will be exempt. If the entire net consideration is not invested, less amount invested, then whatever net consideration invested, in that proportion only your capital gain will also be exempted. Getting my point? Investment must be there in new residential house property only. But that investment is not happening from capital gain. No, no, that investment is happening from net consideration. For example, this was 1 lakh and your long term capital gain was 40,000. Sir, how come your long term capital gain is 40,000? Because out of the net consideration, you would have reduced cost of acquisition, cost of improvement with indexation, without indexation. Depends on the fact that when the asset was transferred, hello, before 23rd July, then out of 1 lakh minus the index cost of acquisition and cost of improvement, you would have got long term capital gain of 40,000. Or if the transfer was made on or after 23rd July, you would have reduced the cost of acquisition, cost of improvement without any indexation. So out of the net consideration, you would have reduced the cost of acquisition, cost of improvement without indexation, or maybe with indexation. It does not make any difference, because whatever gain you are getting, that is long term gain only. Now that long term gain was how much? 40,000. If you want to claim exemption for that 40,000, you have to invest this 1 lakh fully. If the full 1 lakh rupees is invested, full long term capital gain will be exempted. What did I say? Full 1 lakh rupees is invested, full long term capital gain will be exempted. Full 40,000 can be exempted. If less amount invested out of net consideration, then the proportionate amount out of long term gain will be exempted. Now let's say you are making an investment in new residential house property. You are making that investment 1 lakh rupees. Have you invested the entire net consideration 100%? Hello? So if 100% of the net consideration invested, 100% of the capital gain will be exempt. How much will be exemption? 40,000. But to get this 40,000, you did not have to invest 40. No, you had to invest more. You had to invest the entire net consideration. Only then you got the exemption of 40. What if the investment made by you in the new residential house property was 80,000? So out of 1 lakh you are investing 80, meaning that how much investment you are making? 80% of the net consideration is invested, no? How much? How much? 80% of the net consideration invested. 80,000 divided by 1 lakh into 100, 80%. So you are investing only 80% of your net consideration. Hence we can exempt 80% of your long term capital gain. How much? 32,000. Got it, sir? Now pay attention. What if the investment was 1 lakh 80? 1 lakh 80 is investment, meaning that, sir, in this 1 lakh 80, 100% of net consideration you have invested and extra amount also you have invested. Hello? Hence, this will also be exempt 100%. Getting my point? So can I say the exemption under section 54F from LTCG is dependent on investment of net consideration. Investment of net consideration. If investment is greater than or equal to what? Net consideration. Meaning entire net consideration invested. 100% net consideration invested. Yes or no? In that case, full LTCG is exempt under section 54F. Getting my point? Now, if investment is less than net consideration, what will you do? Proportionate long-term capital gain is exempt under section 54F. Getting it? How will you calculate this proportionate LTCG? You will take the amount of LTCG multiplied by investment divided by net consideration. This much amount will be exempt under section 54. Here you have not applied any formula. You are applying the percentage of investment out of net consideration. Whatever percentage investment is made, that percentage you are applying on the amount of capital gain. If investment is 80,000 out of 1 lakh, 80 upon 1 lakh will be 80,000, 80%. That 80% you are applying on long term gain. So 80% investment, capital gain to the extent of 80% will be exempt. Will you remember this? Rest everything is same. What? Investment where? This investment should be done in which asset? Another residential house property. So, if you have shares, for example, if you have shares, example, so net consideration of the shares invested in residential house property, either purchase of one residential house property in India, construction of one residential house property in India, or cannot be done on or before the due date of filing ROI, then can be invested in CGD also. Hello, CGD option will also be available. Will you remember this? So one residential house property in India, in that one residential house property, this net consideration should be invested within 1 year backward, 2 years forward. If purchase is done, if construction is done, then 3 years forward from the date of transfer of shares. If the shares are transferred, so date of transfer of shares from that day within 2 years forward or 1 year backward. From that day 3 years forward. Okay. The new residential house property must be constructed. Now this net consideration, out of this net consideration, whatever long-term capital gain will be there for the shares, that long-term capital gain will be exempt under section 54F. How much will be exempt? Either fully or partly. Fully exempt if the entire net consideration invested. If the amount of investment in residential house property, if that amount is equal to or more than net consideration, then the full LTCG you can claim as exempt. If the amount of investment in residential house property, if this amount is less than the amount of net consideration, then whatever percentage of net consideration got invested, meaning investment divided by net consideration, that is the percentage of investment of net consideration, apply that on the amount of long term gain. To that extent the long term gain will be exempt. Okay sir? Wait, everything I am going to explain, don't worry. This much you understood, no? Now pay attention. Your net consideration was 10 lakh rupees. The LTCG was 4,20,000. Let's take it 4 lakh only. Calculations will be easy. Okay. So if your long term gain is 4 lakh, but your 4 lakh long term gain is out of the net consideration of 10 lakh only. Okay, no? So now you have to make the investment. Tell me, where you will make the investment? Investment net consideration will be invested. So whatever investment is made in the residential property is made out of the net consideration and not the long term gain. Yes or no? So now within that period you are supposed to see that what residential properties you have purchased. Whatever residential properties you have purchased, what did I say? Whatever residential properties you have purchased, the cost of that residential property, whatever residential property we have constructed within that period, the cost of that residential property is met out of this net consideration only. But you have to actually purchase or construction immediately prior to your due date of filing ROI. Only then you are able to get the exemption in your ROI. But what if ROI due date has come and so far you have not been able to purchase or construct? Possible or not? So you have the option to invest in CGD also. It will be assumed that your net consideration which is deposited in CGD account, it will be assumed that your net consideration is invested in CGD account is invested in residential property. So even the investment in CGD, deposit in CGD will be counted that as if this net consideration is getting deposited. Yes or no? So either that net consideration will be invested in purchase or it will be invested in construction. If not, on or before the due date of filing ROI, if not in the purchase or construction, no problem. Deposit this net consideration in your CGD account. So now you have to see how much amount is deposited in CGD on or before the due date of filing ROI. Can I say out of this 10 lakh, 9 lakh was deposited CGD account? CGD account 9 lakh rupees was invested. So up till now what we used to do, we used to assume as if the long term gain is invested in CGD. No, now this investment is not long term gain invested in CGD. It is net consideration invested in CGD. Tell me, entire net consideration deposited? Entire net consideration invested? Deposited? No. So entire capital gain cannot be exempted. You have to see how much is invested, how much is deposited. Out of 1 lakh, out of 10 lakh, 9 lakh is how much? 90% only, no? So if 90% of the net consideration is invested, 9 lakh divided by 10 lakh, 90%, then that 90% of capital gain will be exempt. Apply that 90% on LTCG. So what you will do? You will take LTCG multiplied by 9 lakh divided by 10 lakh. 9 lakh divided by 10 lakh will be 90%. That 90% gets applied to the, okay. So how much will be the capital gain exempt? So the exemption under section 54F cannot be full capital gain, but it will be 3,60,000. Understood, sir? Can you do this? Now the moment you have deposited the amount in CGD, you have to remember the amount will be withdrawn and has to be used in the balance period to purchase or construction. Only then this exemption will remain with you. But what if you withdraw that amount of CGD and misutilize? Then whatever amount which you misutilize used to become your deemed capital gain. Here you will do, you are gone. Amount withdrawn and misutilized cannot be treated as your deemed LTCG now. Out of this CGD account, whatever amount you are withdrawing and misutilizing. See, please look at me. Out of this CGD account, whatever amount you are withdrawing and misutilizing, against this amount, how much proportionate long-term gain was exempted? That will be your deemed LTCG now. So for example, out of 9 lakh, you have withdrawn 1 lakh and that amount is misutilized. Misutilized how much? 1 lakh. So if against 9 lakh, 3 lakh 60 was exempted. So against this 1 lakh, how much was the exemption availed by you? This 1 lakh was not the exemption. Because that 9 lakh is also not the exemption. If 9 lakh was deposited, 360 was exempted. Then how much will be the exemption against this 1 lakh rupees? It will be 90% only, no? 40,000 rupees. So that amount out of this 40,000, which is the proportionate long-term gain exempted here. Hello? Which was the proportionate long-term gain exempted here. Out of this 40,000 will now be treated as deemed LTCG. Deemed LTCG in the previous year, in which the amount of 1 lakh is misutilized. Don't commit a mistake by treating 1 lakh rupees as deemed LTCG, which you used to do up till now. Will you remember? Sure. Now tell me, out of 10 lakh, 9 lakh got invested in CGD. Now out of this 9 lakh, 1 lakh is what? Misutilized. So 8 lakh should have been utilized. 8 lakh should have been utilized. But do you know, out of this 9 lakh, 1 lakh is misutilized. So out of this 9 lakh, only 7 lakh was utilized, means used to purchase or construct new residential house. So you invested 9 lakh in CGD, claimed the exemption of 360, saying that you will be using the entire 9 lakh for what? For purchase or construction of new residential house. Wow, very good. But did you utilize the entire 9 lakhs? Or only 7 lakhs to purchase or construction of new residential house? Only 7. So against this 7, how much exemption should be there? Against this 7 lakh, how much exemption should be there? If against 9 lakh, 3 lakh 60 is there. So out of that 9, this 7 is there, no? Against this 7 lakh, how much exemption should be there? 2 lakh 80. 2 lakh 80. So 2,80,000 is still exempted. Is it okay? The answer is yes. This is still exempted. Under section 54F, this exemption will remain with you. We are not going to do anything with this exemption. So out of 9, if the 7 lakh is invested, then 2,80,000 exemption claimed was okay. No problem in that. Now what it means, that after the 3 years period will expire from the date of transfer of shares. From the date of transfer of shares, now 3 years will expire. After the expiry of 3 years, don't you think there will be some unutilized amount still remaining in your CGD account? How much will be that unutilized amount? 1 lakh. Because out of 9, 1 lakh is misutilized, 7 lakh is utilized. So on the expiry of 3 years, how much amount will still remain in the CGD account? It will be 1 lakh, no. So out of this 9 lakh, 1 lakh is still remaining unutilized. So can I say against this 1 lakh, how much proportionate capital gain was exempted? 40,000 only, which is there in this 360, will now be treated as your deemed LTCG for the year in which the period of 3 years expire. So the period of 3 years expiring in the previous year, the year in which that period of 3 years will expire, in that year the amount remaining unutilized in the CGD account will not be taxable as your deemed LTCG. The proportionate gain against that amount which got exempted, that amount will be treated as your deemed LTCG in that year. Please don't commit mistakes over here. This is a new point, only this is the new point. Will you remember? Sure. Now tell me, how much was your capital gain? How much was your net consideration? It was 10. How much capital gain you earned? 4 lakh. Out of 10 lakh, you have invested 9 lakh. So your 360 capital gain got exempted. So right now you have already paid tax on the balance 40,000. So what will be your taxable capital gains right now? Come on, tell me. 40,000. Out of 4 lakh, 3 lakh 60 will be exempt and 40,000 capital gain you will pay tax. Meaning that the 3 lakh 60,000 of capital gain which got exempted, it got exempted right now because you invested 9 lakh rupees in CGD, no? So whatever investment in CGD is done, remember that amount has to be utilized within the balance period for purchase or construction of residential house. If the amount withdrawn from CGD account and misutilized, then whatever proportionate long-term gain which was exempted against that misutilized amount, that proportionate long-term gain will be treated as your deemed LTCG. Whatever amount remaining unutilized out of the CGD account on the expiry of 3 years from the date of transfer of original asset, from the date of transfer of original asset, 3 years you are supposed to count. Within those 3 years, the amount has to be invested either in purchase or in construction. So on the expiry of that 3 years, still some amount is remaining unutilized in the CGD account. So whatever proportionate long-term gain which was exempted against this amount unutilized, against that, whatever proportionate long-term gain was there which got exempted, that proportionate long-term gain, that proportionate exemption will be deemed as long-term capital gain in the year in which the period of 3 years expire. Now can I say you have acquired one asset, acquired one residential house property whose cost was 7 lakh. That cost was this 7 lakh only. Or you might have acquired some residential house property whose cost was more than 7 lakh, but out of that cost 7 lakh was from this CGD only. Yes or no? So this 7 lakh out of CGD account, this 7 lakh is already invested in new residential house property, meaning the new residential house property purchased or constructed. In the purchase cost, in the construction cost, out of 9 lakh, you have invested 7 lakh in the purchase cost or construction cost. So this 2 lakh 80, which was exempted under 54F, which was exempted under section 54F, will still remain with you. But remember, if this new residential house property, if this new residential house property is transferred within 3 years, lock-in period of the new residential house property will be 3 years, then this will also be taken back. Revocation. Hello. Not just this new residential house property, any other residential house property purchased. What did I say? Any other residential house property purchased other than this within 2 years, then also this will be taken back. Any other residential house property constructed within 3 years from the date of transfer of original asset. So from the date of transfer of original asset, you were supposed to buy one or construct one. So the one which you have bought, the one which you have constructed, based on that you are getting this exemption, yes or no? Other than this, one more bought. Other than this, one more constructed, then this will be revoked. And even this is transferred within 3 years, then also this will be revoked. Me understanding? So what I was transferring, tell me? I was transferring shares. Okay, shares. So I have to see date of transfer. So from the date of transfer of shares, okay, within 1 year backward, 1 year backward, or within 2 years forward, or within 3 years forward, whatever investment I have made, RHP, 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 which was purchased or construction, based on this investment, what did I say? Based on this investment, my LTCG is exempted. LTCG of shares is exempted under section 54F. So this is already a property which you have acquired by using the net consideration of these shares. Other than this property, one more property purchased within 2 years. Other than this property, one more property is constructed within 3 years. Then whatever exemption you have got now, right now, will be taken away, revoked. And remember, this also cannot be transferred within 3 years from its date of acquisition. Getting my point? Sure. As on the date of sale, as on the date of transfer, as on the date of transfer of your shares, how many residential house property you can have? No residential house property. Then invest in one residential house property. As on the date of transfer of shares, one house property you can have? Yes. Invest in one more so that it becomes two. But as on the date of transfer, you already have more than one residential house property. So now this investment, even if this investment is made, will not be eligible for 54F exemption. 54F exemption you are not going to get. Yes or no? Because you are already the owner of more than one residential house properties. So now investing in one more residential house property will not, entitle you to claim the exemption under 54F. So for you to claim that exemption, either you should not have a residential house property or you should have at least one residential, maximum one residential house property. So you invest in one more residential house property, you are going to get the exemption under 54F. Now, apart from this investment, one more residential house property is purchased, or one more residential house property is constructed. Yes or no? One more residential house property purchased or constructed. One more residential house property is purchased or constructed. Based on this investment, have you got 54F exemption? Yes. So this property should not be transferred within 3 years from the date of its acquisition. Minimum lock-in period of this property will be 3 years. Apart from this property, one more purchased, one more other property constructed, then also whatever exemption you have taken right now will be taken away, will be revoked. Understanding? Hello? So, what is the lock-in period? 3 years. And additional residential house property purchased or constructed within 2 or 3 years from date of transfer of original asset, then also exemption under section 54F will be revoked. And if this property whose lock-in period was 3 years, if this is also transferred within 3 years, then also exemption under 54F will be revoked. Sure, sir? This was 54F. Now, how the revocation will be made? Reduce that amount out of the cost. No need to do it. 54EC, beautiful. Whenever the default is committed, meaning the bonds are transferred, the bonds are kept as security to get the loan, the bonds are converted into money, in that year, whatever amount which was exempted under 54EC, that amount will be treated as deemed LTCG. That's it. The same thing you are supposed to do here also. The year in which you will transfer the property, this property, the year in which you will transfer this property. Have you transferred it within 3 years? Yes. So, the property in which you invested and claimed the exemption, now you are transferring that property within 3 years. The year in which this property will be transferred, in that year, whatever amount of exemption available with you under section 54F, that amount will now be treated as your deemed LTCG directly. No need to reduce from cost and all. Now, if one more residential, other than this, one more residential property purchased or one more residential property constructed within 2 years or 3 years, so that the year in which one more residential property purchased or constructed, in that year, whatever exemption under 54F you had, that will be treated as deemed LTCG in that year. Getting my point, everyone? Sure. How much maximum investment you can do in one residential house property? That 10 crore limit which was there in 54, no? That 10 crore exact same limit is here also. Now, do you remember there was once in a lifetime option to invest in 2 properties to get the exemption under section 54? That once in a lifetime option is not available here. No. So, your net consideration should be invested in new residential house property, but the amount invested in the new residential house property, meaning the cost of new residential house property purchased or construction, should not be more than 10 crores. If it is more than 10 crores, then amount up to 10 crores will only be counted. Hello, sir? Not more than that. And if your amount of long-term gain is up to 2 crores and you say that now I will invest in 2 residential properties to get the exemption, you cannot do it here. You have to invest only in one residential house property to get the exemption. Getting my point? So now tell me one thing. I will ask you. For example, your long-term capital gain was, for example, it was 40 lakhs. How much was long-term? No, it was not 40 lakhs. Let's assume that it was 4 crores, 4 CR. Now, out of this long-term capital gain on transfer of jewelry, example, you transferred jewelry. So, what was the long-term capital gain on transfer of jewelry? 4 crores. Now, if you want to claim the exemption of this 4 crores, what you are supposed to do? You are supposed to invest the net consideration of the jewelry. Net consideration of this jewelry, you are supposed to invest in one residential house property. Yes or no? So, that investment of the net consideration cannot be more than 10 crores. Getting my point? Now for example, the net consideration of the jewelry was 8 crores. How much? 8 crores. And out of 8 crores, 4 crores is what? Long term gain. Now if you want to invest, if you invest this net consideration in new residential house property, meaning new residential house property purchased for 8 crores. New residential house property purchased for 8 crores. Meaning that entire 8 crore invested in new residential house property, entire 4 crores will be exempted. Yes or no, sir? Now pay attention. Please look at this. Net consideration was 12 crores. So, sir, as you said, if the entire net consideration of 12 crore is invested, entire 4 crores will be exempted. Yes or no, sir? So I invested entire 12 crore. I bought a property. I constructed a property for 12 crores. Anything over and about 10 crores will be ignored. So even your investment out of this, which is more than 10 crores, that investment will be ignored. Only 10 crores can be counted. So can I say, if I go and take the exemption under section 54F, yes or no? So to claim this exemption, I will have to now check what was the amount of investment. Okay, no? So investment was, example, entire 12 CR was invested. But this should not be more than, the amount of investment should not be more than 10 crores. Getting my point? Now that I have to divide. That I have to divide from the value of my net consideration. So my net consideration was 12 crores. So out of 12, 12 is invested. But wait, any investment over and above 10 we will not count. Meaning that the entire net consideration invested, even if we will count only 10, because any investment over and above 10 we don't consider only for the exemption. Meaning that here this or this, whichever is lower, meaning this 12 crore will not be counted, only investment of 10 crores will be counted. So out of 12, how much is invested? Only 10. Out of 12, how much is invested? Only 10. 5 by 6, 5 by 6, 5 by 6. So the capital gain will also be exempted 5 by 6. 5 by 6 means what? This 10 crores, 10 crores, 2 more zeros. Hello, sir. 2 more zeros. Yes. So this 10 crores out of 12 crores is how much? 5 by 6 only, no? So out of the capital gain, 5 by 6 will be exempt. Either you find out the percentage or you take the proportion. That proportion you apply to long-term gain. So from this also, 10 by 12 will be exempt. How much will be 10 by 12? Come on, tell me. How much will be 10 by 12? 3.3. Everyone getting 3.3? 3 crores 30 lakhs. Heavy, no, this section? So many new things to learn. Got it? Now what if I actually invested only out of the net consideration, I actually invested 6 crores only. Possible or not? So is your investment more than 10 crores? No. So count the entire investment only. So count this amount, divide by this, 50%. So 50% of your capital gain, meaning 6 by 12 will be exempt, meaning 2 crores. Yes or no? Will you be able to do these kind of calculations? Sure. Perfect. Very good. Okay. So this was your section 54F, which is over. Remember, if you are an individual or HUF, what did I say? Individual or HUF. You have transferred any capital asset other than residential house property as on the date of transfer of this capital asset, the assessee shall own less than equal to 1 RHP, must be owned, not more than one residential property. So if you transfer this capital asset other than residential house property, so the net consideration of this, out of that LTCG will arise. That LTCG will be exempt under section 54F, but for that you need to invest your net consideration. Remember, the investment of net consideration means purchase of residential property, construction of residential property. If done on or before the due date of filing ROI, then it is okay. Otherwise, CGD, whatever investment you are making in purchase or construction out of net consideration. Getting my point? To that extent, your capital gain will also be exempt. But remember, the investment in residential property more than 10 crores will be ignored. Only up to 10 crores investment will be considered. Yes or no? So now whatever may be your net consideration, whatever may be your long-term capital gain, out of the net consideration, if you have invested an amount in the residential property and that amount is 10 crore or less, then consider the entire investment, no problem. But if out of the net consideration your investment in the new residential property or CGD is more than 10 crores, then any amount over and above 10 crores will be ignored. Investment to the extent of 10 crores will only be considered. Sure, sir? Sure? Now, the amount invested in CGD, based on that your capital gain will be exempt. So if that amount is withdrawn and misutilized, if that amount remains unutilized, then whatever amount which is misutilized from CGD account remains unutilized in CGD account, any gain proportionate to that amount which was claimed as exempt will be treated as your deemed long-term gain in the year of misutilization or in the year in which the period of 3 years expire. Yes or no? One residential property you are supposed to purchase. One residential property you are supposed to construct. Only one residential property can be purchased or constructed. The purchase or construction of 2 residential properties, if your long-term gain is up to 2 crores, is not allowed here. That is allowed only in section 54. But the restriction of the investment of 10 crores was applicable there also, applicable here also. Got it, sir? If this residential property in which you have invested your net consideration, if this residential property is transferred within 3 years, then whatever exemption which you have got by investing in this residential property, that entire exemption will be revoked by treating that amount as your deemed LTCG. No need to reduce from cost also. Getting my point? Other than this property, the property in which you have invested and claimed the exemption, other than this property, one more property purchased or one more property constructed from the date of transfer of original asset, one more property purchased, one more property constructed within 2 years or 3 years from the date of transfer of original asset, then also whatever investment you have made and based on that, whatever exemption you are getting, that exemption will be revoked. Got it? This was 54F. Over. All the exemptions are done now. Okay. Now we are going to discuss about the tax rates. What are the tax rates applicable for different types of capital asset? Once we are through with that, the chapter will be over. Okay. Now let's pay attention. Very important discussion. The discussion which I am going to do now for tax rate, very, 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 very important discussion. You are not supposed to take this thing lightly, because in the examination they exploit these kind of concepts which I'm going to explain now. Okay, so tax rates. On short term capital gain, on long term capital gain. Short term capital gain taxable at normal rates also, at rates prescribed under section 111A also. Long term capital gains taxable at rates prescribed under section 112A also, at rates prescribed under section 112 also. Now your long term capital gain will always be taxed at special rates, whereas one short term gain will be taxable at special rate. All the other short term gain will be taxable at normal rates. They are your normal income. Salaries income, what is the rate of tax? Normal rate. PGBP, normal rate. Other sources, normal. All the incomes, normal rates only. So your short term capital gain also at normal rates, but one specific type of short term capital gain will be covered by 111A. On that short term gain, you are not supposed to pay normal rate, you are supposed to pay special rate prescribed in that section. On all your long term capital gains, whether the long term capital gain is covered by 112 or it will be covered by 112A, on all your capital gains, special rate is there. So long term capital gain can never be taxed at normal rates. They will be taxable at special rates, either given in section 112 or given in 112A. Okay, so now we are going to discuss first about the short term capital gain. Okay, pay attention. Wow, sir. Short term capital gain arising on transfer of short term capital asset. Which short term capital asset? Being listed equity shares or units of equity oriented mutual fund or units of business trust. Okay, now any of these three assets must be transferred on or after 1st October 2004 on a recognized stock exchange, and STT is levied on the transfer. STT is also levied on the transfer. If all these conditions are fulfilled, transfer of this asset only on or after 1st October 2004 on a recognized stock exchange, and at the time of transfer STT must be levied on the sale transaction. By satisfying all these conditions, if the short term capital asset is this and all these conditions are fulfilled, and any short term capital gain arising on these short term capital assets, in this situation is covered under section 111A, and taxable at the rate of 15% if transferred prior to 23rd July 2024, meaning that there is a change in the rate of tax. If the transfer was made on or after 23rd July now the rate will not remain same, now the rate will change. Same type of transaction happening, but the transfer is happening on or after 23rd July now. So if the transfer is happening on or after 23rd July and the short-term gain is calculated, now that will be covered by 111A, but will be taxable at 20%, my dear friends, 20%. If transferred on or after 23rd July 2024. So can I say first amendment is the rate is increased? Hello? Rate is increased from 15 to 20. So now these type of short-term capital gains arising on or after 23rd July, arising from transfers made on or after 23rd July 2024 will no more be taxable at 15%. Now they will be taxable at 20%. So you have to be very careful. You have to see any of these assets are transferred? Yes. Period of holding less than equal to 12 months, because for them the period of holding to be checked is 12 months only. Okay. So if the period of holding is less than or equal to 12 months and the transfer was made on or after 23rd July, transfer was made on a recognized stock exchange, at the time of transfer STT is also paid. So that is known as STT paid short-term gain. What will you say? STT paid short-term gain. Now that will be covered by 111A. And since the transfer was made on or after 23rd July, now any gain which will arise, short-term gain which will arise, that short-term gain will be covered by 111A. But will not be taxable at the older rate. Now it will be taxable at a new rate of 20%. If the same transfer would have happened prior to 23rd July, then that time the rate of tax was only 15%. Government wants to demotivate the people, demotivate the investors for not trading shares in a very short span of time. Government wants you to stay invested for long durations. And now many of the people have started opening their accounts. Grow is there, Zerodha is there, then many other, discount brokerage have started. So because of that, now many people have, come in the capital markets. They've started investing, but they don't remain for a long time. They come and they go, they come and they go. So we don't want you to come and go and buy and sell within very short span. If you're coming, then stay invested for at least 12 months, no? If you're not staying invested for 12 months, you're earning any short-term gain, then your short-term gain, earlier it used to be taxed at what rate? 15%. Now we will tax it at 20%. Still it is a concessional rate. Still we are not charging this short-term gain at normal rates. Because if we charge this short-term gain at normal rates, understand, over and above 10 lakh, whatever gain will happen, that will be taxed at 30%. Yes or no? And if you are following 115 BSE, over and above 15 lakh, whatever income will happen, that will be taxed at what rate? 30%. So we are not charging any 30% rate, but a flat rate of 15% we used to charge. That was a concessional rate. But that flat concessional rate, we are increasing 20%. But that is still a concessional rate for you. Getting my point? Earlier when this section came, in 2004, that time the rate was only 5%. Then slowly, gradually it increased to 10%. Many years I taught 10% to the students. Then few years back, 6-7 years back, it got increased to 15%. Now see, today it is So since the time I was a student, no, I have seen this rate to be 5%, and I have seen this section changing the rates every now and then. So as a student also I have studied, and as a teacher also I am teaching it, the same section, and I have seen that since that time till today the things have changed drastically. Asset remaining same, gain remaining same, covered under the same section, conditions are remaining same, but every now and then the rate is increased. Now the rate is increased to 20. From next year onwards, whatever gain will arise is arising on transfer on or after 23rd July only, no? Only 20% rate. Done. This year there can be a problem, because during the previous year they can tell you that the asset is transferred prior to 23rd July. Then you will have to apply 15%. But if they are saying that these assets are transferred on or after 23rd July, then you will have to apply 20%. Yes or no? Now, any other short-term capital gain arising on transfer of short-term capital asset being any other capital asset. Any other means other than these three covered under this situation. Yes or no? In any other case, taxable as normal income only at normal rates. That's it. This was the tax rates on short-term capital gain. Okay? Did you understand short-term capital gain, the tax rates? Only this much you are supposed to remember. Okay? There is an important discussion regarding short-term gain 111A, but that discussion I am going to do with long-term gain discussion. Yes or no? Don't worry, those things will be covered. But right now, did you understand only this much? Okay, very good. Now pay attention. Now we will discuss about the long-term capital gain. So what I am saying, please pay attention. Copy and I will do paste. Wait, don't write anything. First, let me make this. This is long-term capital gain on transfer of long-term capital asset being listed equity shares, unit of equity oriented mutual fund, units of business trust. If listed equity shares are there, STT paid on acquisition also. There is one additional requirement that for the listed equity shares, not in the case of units, but for listed equity shares, the STT should be paid at the time of acquisition also. Okay, this is only one requirement. Transferred on or after 1st April 2018 on recognized stock exchange and on which STT is levied on the transfer. So this short-term capital gain will be covered under section 112A. Okay. Now earlier what used to happen, if it was covered under section 112A, and if it was transferred prior to 23rd July, okay, wait, if it was transferred prior to 23rd July, what used to happen, that it was covered under section 112A, which said that up to 1 lakh no tax, and on excess amount there was a tax of 10%. This was the tax rate prevailing if the transfer was made prior to 23rd July. Now in this 112A also they have made a change same thing will be written over here. Okay, now this nil will remain nil. But now instead of 1 lakh, you will get 1.25 lakhs. 1.25 lakhs. And on excess, you used to pay 10%, now you will pay 12.5%. This is the change which they have brought. Up to 1 lakh? No, now it will be up to 1 lakh 25, you are not going to pay any tax. And excess will be taxable at 12.5% instead of 10%. Okay? Sure, sir? Pay attention, huh? Pay attention. What are you transferring? You are transferring any listed equity shares on which you paid STT at the time of acquisition. Meaning at the time of acquisition you have acquired them through recognized stock exchange by paying STT. See, there are certain exceptions. Bonus will be there. At that time you might not have paid what? STT. That is an exceptional case. Okay, no problem in that. In that case, if you have not paid STT, then also it is okay. Because bonus, you are getting the shares in bonus, no? Sometimes you have shares of unlisted company. That company gets amalgamated with some listed company. So against the shares of your unlisted company, you will get the shares of listed company. They will be issued directly. For that also you are not supposed to pay any STT. So there are certain cases which are kept as exceptions, that in these exceptional cases, even if STT is not paid at the time of acquisition, then also okay. But other than these exceptional cases, if you are going and buying the shares from the market, you have to compulsorily pay STT and acquire the listed equity shares. Yes or no? Hello, sir. So at the time of acquisition, STT must be paid. For units, there was no requirement. For acquisition of units, STT was paid, then also okay. Not paid, then also okay. But whenever these shares or units will be transferred, remember the period of holding should be more than 12 months. Meaning they are long-term capital asset. Whenever they will be transferred, they have to be transferred on recognized stock exchange only. On or after 1st April 2018, they are transferred. They have to be transferred on a recognized stock exchange only. But at the time of their transfer, compulsory STT has to be levied. If this happens prior to 23rd July and the long-term gain arises, that long-term gain will be covered by 112A. Up to 1 lakh, there will be no tax. Calculate the capital gain. Show that capital gain in the computation of your total income. But when you calculate the tax, don't calculate the tax on 1 lakh. Entire long-term gain has to be shown in the computation of total income. Entire long-term gain will be shown as a part of your total income. When you will separate it from the total income to apply the tax rate, don't apply any tax on 1 lakh. Leave. Any long-term gain shown in your total income, any long-term gain of 112A shown in your total income, which was over and above 1 lakh, on that only you calculate 10%. But now this also has been changed. Now if the transfer was made on or after 23rd July 2024, now these assets are transferred on a recognized stock exchange on or after 23rd July also. Then long-term asset, yes. Long-term gain you are calculating under section 112A, yes. Do one thing. Now whatever long-term gain you have calculated, entire long-term capital gain show in the total income computation. Now from the total income, when you will separate it to calculate the tax, on the first 1,25,000, don't calculate any tax. Capital gain over and above 1,25,000, on that calculate 12.5%. Getting my point? Now wait. Few shares you will sell prior to 23rd July. Few shares you will transfer on or after 23rd July. Possible? So this 1 lakh limit will be separately for them. 1,25,000 will be separate. No. For the full year, the limit is 1 lakh. For the full year, the limit is 1 lakh 25. Getting my point? So in this previous year 24-25, previous year 24-25, you have sold the shares just prior to 23rd July only. Only these shares were sold. 1 lakh limit, over and above 1 lakh, 10%. That's it. If the transfer was made, all the shares are transferred, forget about 23rd July, all the shares are transferred on or after 23rd July. Apply 1,25,000 limit, whatever excess is there, on that apply 12.5%. There will be no problem here. But when during the year, some of the shares are transferred prior to 23rd July and some shares are transferred on or after 23rd July, now your total long-term gain under section 112A will be there on this total. You are supposed to apply only one, either 1 lakh or 1,25,000. You are not supposed to take 1 lakh separately for those shares which are transferred prior to 23rd July, 1,25,000 separately for those shares. No. Two limits will not be available. Only one limit will be available. So, do one thing. Entire long-term gain prior to 23rd July, on or after 23rd July, take the entire long-term gain. On that entire long-term gain, apply 1,25,000 limit. How much? 1,25,000. Any long-term gain over and above 1,25,000 will now be taxable. At what rate? 10%. That long-term gain which was prior to 23rd July, separate that, on that apply 10%. And on the remaining only you apply 12.5. Now what do I mean to tell you? Pay attention. If prior to 23rd July, I mean to say this one, okay, no? Here my capital gain was 2 lakhs. Possible? Here it was 2 lakhs. And here it is 60,000 only. So what is my total gain? 2,60,000. Hello? Total gain is 2,60,000 only, no? Out of that 1,25,000 remove. Now I will remove 1,25,000 because for the full year now the limit has been changed. So I will take the overall higher limit and not the lower limit. Okay. So I will forget the lower limit and I will take overall higher limit. What is that? 1,25,000. So reduce 1,25,000. So out of 2,60,000, you will get 1,25,000. If you will reduce, you will get 135 exact. Now see, if you say that this 135, out of this on 60, if you will calculate what? On 60, you will calculate 12.5%, and on the balance 75 you will calculate 10. That is not good. What you will say? Whatever is remaining now is remaining out of my capital gain which I earned earlier, which was taxable at 10%. So that 1,25,000, the benefit which you have taken, no, 1,25,000, utilize that 1,25,000 first from 60, eliminate 60. How much still remaining? 65. Eliminate that 65 from 2 lakhs. Getting my point? Now how much remaining? 135. That 135 remains from that 2 lakh only. Apply 10% on that. Ayyo. Understanding? I will take one more example so that the things are clear. Exactly clear. Okay. What if this is also 80? This is also 80. Total is how much? Total is 1,60,000. Okay, no? You will apply 1,25,000 limit. So that 1,25,000 will be first used to remove the 80,000 taxable at 12.5%. Forget about that. How much more? 45. 45 you remove from the earlier 80,000. So now how much will remain? Only 35 will remain, no? That 35 is out of that 80,000 which was transferred prior to prior to 23rd July. On that 35 you apply 10%. So always try to use that limit of 1,25,000 out of the gain which you have earned by transferring on or after 23rd July. Yes, use it. Because if you will use it against that gain, your gain which is taxable at higher rate is getting lower and lower. Now whatever out of 1,25,000 remains, okay, no, on that you apply, sorry, that amount you apply from the earlier gain. Now tell me, if I give you one more example, this was 2 lakh and this was 1 lakh. So total is 3 lakh. 1,25,000 has to be removed. So I will remove 1,25,000, but that entire 1,25,000 will be removed out of 2 lakhs. I will not reduce that 1 lakh, which is taxable only at 10%. Getting my point? I will reduce that 2 lakh, which is taxable at 12.5%. So from that 2 lakh, I will reduce 1,25,000, and 75,000 which remains will be taxed at 12.5%, and that 1 lakh will be taxed at 10%. Getting my point? You have to do it like this. For this year only. From next year onwards, entire 1,25,000 remove. Whatever remains, on that you are supposed to apply 12.5%. Getting my point? This year, you are very special people, no? Got it, sir? Will you remember this? Sure. Now see, this is your long-term capital gain, no? This is your long-term capital gain covered under section 112A. Okay. If the transfer is made on or after 1st April 2018, do you know that if such same transfer made prior to 1st April 2018, then long-term gain which was resulting, no? Long-term gain was fully exempt under section 1038. That time there was one section, 1038. Under 1038, this transaction used to get fully exempt. But with effect from 1st April 2018, if the transfer is made, now that exemption is gone. Now 1st April 2018 or afterwards, whenever you will transfer, now the gain will be calculated under section 112A. And will not be taxable up to the first 1 lakh. Okay. Over and above that only we will charge 10%. See, earlier we were giving you the full exemption. No. If you are taking back that exemption, so you should not be taxed on the full amount. Okay. We are not taxing you on the full amount. Just eliminate 1 lakh. On that first 1 lakh, we are not going to charge any tax. Over and above that, whatever will be there, on that we are going to charge tax. And that too also very concessional, 10% only. Now they have increased the rate 12%. So to justify that, they have increased the limit also, 1,25,000. And why they have increased the rate of 12.5% over here? They are saying that all the capital gains which are long-term capital gains should be taxable at same rates. 12.5 only. So if we are making the 12.5% rate under section 112 also, then it should be 12.5% for 112A also, which was earlier 10%. Yes or no? So we are making the tax rates same. We are making the tax rates same for all the capital assets, for all the long-term gain. If under section 112 we are making 12.5%, so under section 112A also we are making 12.5%, which was earlier 10. So people will start screaming. So increase the limit a little bit. Instead of 1, make it 1,25,000. Earlier, no, prior to 1st April 2018, this gain was not taxable only. If these assets were transferred as long-term capital asset by satisfying all these conditions, all the conditions are fulfilled, but the transfer was made on the recognized stock exchange by paying STT. Hello? And on acquisition also, in case of listed shares, the STT was paid. If all the conditions were fulfilled and the transfer was made prior to 1st April 2018 till 31st March 18, whatever long-term gain was there, no, that was fully exempt at that time. I have taught that also and I am teaching this also. Now, whenever you will calculate this long-term capital gain, no, under section 112A, so to calculate this long-term capital gain, under section 112A, long-term capital gain under section 112A, you will always take the full value of consideration. This will be the selling price of your shares on the stock exchange. At what price you are selling the shares, that will be your full value of consideration. Very simple. Minus what? Transfer expense. So there will always be brokerage. And remember, brokerage you will reduce as transfer expense, but STT paid at the time of sale will not be allowed as a deduction, because while calculating the capital gains, no deduction for STT is allowed. Do you remember that? So any STT paid at the time of transfer shall not be reduced. Getting my point? Though it is STT paid short-term gain, though it is STT paid long-term gain, but the STT paid at the time of transfer will not be reduced as transfer expense. And also the STT paid at the time of acquisition will not be added to the cost. Because while calculating capital gains, STT is not to be allowed as a deduction, not as a transfer expense, and neither as what? Cost of acquisition. So ignore this. Okay, no? This is ignored. So transfer expense will be brokerage. Now you will get what? Net consideration. Now out of this net consideration, no, you will reduce cost of acquisition. And for this cost of acquisition, indexation benefit was not allowed. Even if the transfer was made prior to 23rd July, that time also the indexation was not allowed. The moment they have brought 112A, no, from that moment only they have told that whatever capital gain which is going to be computed under section 112A, on that capital gain, indexation benefit will not be available. Entire cost only will be reduced. Cost without indexation must be reduced. Yes or no? So cost you will reduce without indexation. Cost of acquisition always without indexation, and you will get what? Long-term capital gain under section 112A. And out of this, what you will do? First 1 lakh, no tax. Excess 10% if the transfer was made prior to 23rd July. If the transfer is made on or after 23rd July, then up to 1 lakh 25, no tax. Excess 12.5%. Will you remember? Now do one thing. This long-term gain you calculate for all the shares which have transferred throughout the year prior to 23rd July, on or after 23rd July. Add all the long-term gains then. Now long-term gains, full year, the available limit is 1,25,000. Will you remember this? Will be utilized first from the long-term gains which are happening by transfer on or after 23rd July, because they are taxable at higher rates. The same examples we have done. Okay, no? Will you be able to calculate your long-term gain like this? Everyone, but wait. The cost of acquisition which you are taking here, no? This cost of acquisition, for this one important discussion is required to be done. Very important discussion. What discussion I want to do, Please pay attention. What will be the cost of acquisition which you will reduce from here? The actual cost. The cost at which you have acquired the shares, you will reduce the actual cost only, no? Wait, no. If such assets, all the three assets, okay, acquired prior to 1st February 2018, if such assets acquired on or after 1st February 2018. Can you see the date? I have not written 1st April 2018. I have written 1st February 2018. Don't you think that this was the day on which the amendment would have been announced in the budget? Budget which is applicable for 2018-19 starting from 1st April 2018. So this date the budget came, and in the budget that announcement was made that from now onwards 1038 exemption will not be available with effect from 1st April 2018. The exemption will not be available, and this gain will be taxable under section 112A. Long term gain will be taxable under section 112A if the transfer was made on or after 1st April 2018. So that announcement that with effect from next year, with effect from 1st April 2018, there will be no exemption under 1038 and the same gain will now be covered by 112A. That announcement was made not on 1st April 18. That announcement was made in the budget for 2018, and that budget came on 1st February 2018. Okay, no? So there is a possibility that you would have actually acquired those shares prior to the announcement in the budget, thinking that you will hold them for long term. Long term gain will arise, and that will be exempt under section 1038. Till 31st January. Till 31st January, there was a gain also, but you did not sell those shares. What happened? I will tell you. Okay, wait. See here. You acquired the shares in 2014-15. You acquired the shares. Equity shares. Okay, no? So you acquired equity shares of X Limited. At the time of acquisition, you paid STT. And the cost of acquisition of these shares, actual cost was 1 lakh rupees. Example. Now assume that at the time of acquisition, did you ever think that on 1st of February the finance minister will come and say that now the long term gain will not be exempt? At the time of buying, at that time 1038 was applicable. So what you thought at the time of buying? You thought that okay, I am buying these shares. Now these shares I will be holding for more than 12 months. Long term gain will arise, and that long term gain will be exempted under section 1038. At the time of buying only you are aware that long term, if I hold, no, so the long term gain, whenever they will be realized, that long term gain will be fully exempt in my hands. So thinking that you invested and now you are holding them, okay, you are holding them as on 31st January 2018, meaning the day, the night prior to that black day, 1st February 2018, the day on which the budget came for 2018. Yes or no? The immediately preceding night when you went to sleep, you saw that the fair market value of these shares was already 2,10,000. Possible or not? Meaning that you are already in a gain of rupees 1,10,000, which you were thinking that, see, now I have already held the shares for more than 12 months. Now this gain is my long term capital gain, which should be exempted under section 1038. You were thinking that only. At 31st January night, you thought that okay, 1,10,000 appreciation has taken place. Now whenever I'll sell, this 1,10,000 will be realized. On that I am not supposed to pay any tax because this 1,10,000 is my long term gain covered by 1038. Yes or no? And you went for a sweet sleep. Sweet dreams were coming in the night. Now all of a sudden, on 1st of February 2018, this is the budget day. This is the budget day. In the morning, in the parliament, the finance minister came, and that finance minister made an announcement that okay, the exemption which we were giving for such long-term gain will now no more be available. Not from immediate effect. But if the shares are transferred on or after 1st April 2018 now this exemption will not be available. Gone. Now that gain which was exempted under 1038 will now be, exact same gain will now be covered by 112A. Yes or no? Now if that will be covered by 112A, and indexation will also not be given. Up to 1 lakh we will not charge tax. Over and above that we will charge only 10%. That announcement was made. Now just imagine, if you want to realize this gain and not pay tax, you sell the shares till 31st March. Till 31st March, we are still giving you the option to claim the exemption. So if you don't want to pay any tax on the long-term gain up to 31st March, whatever long-term gain will happen, on that we are not going to pay any tax. Okay, no. But you did not decide to sell these shares. And you are selling these shares in the future now. For example, can I say these same shares are sold by you now in 24-25? Meaning on or after 1st April 2018, you are transferring in the previous year 24-25? Yes or no? Now, this finance bill 2018 was announced in this 1038 revoked and 112A introduced. Okay, no, in this date. Now in the previous year 24-25, if you will sell the shares, so can I say the shares, equity shares of X Limited, equity shares of X Limited you sold, and at the time of sale also you paid STT. Okay, no? And you sold them for, selling price was, example, 3 lakh rupees. Yes or no? Selling price was 3 lakh rupees. Now tell me, can you see there is a graph? Can I say 14-15 to 31st January 2018 to 24-25? The value of your share is increasing. 1 lakh became 2,10,000 and 2,10,000 worth of shares you are selling for 3 lakhs. Graph is going like this. Yes or no? Now tell me, the shares which you acquired prior to 1st February, okay, now you are selling them in 2024-25. Now you will have to calculate the capital gains. Now if you will calculate the capital gains, what will happen? Full value of consideration you will take how much? 3 lakh rupees. Brokerage will be confirmed there, okay? No, but I'm not taking brokerage here for the sake of, making the computation easier. So there was no transfer expense. Net consideration will be 3 lakhs. Now tell me, what was your cost of acquisition? Cost of acquisition you will have to reduce, no? The cost at which you acquired the shares will be your cost of acquisition. So cost of acquisition was 1 lakh. Okay. Now if you will reduce 1 lakh from here, and they are saying that you will not get any indexation benefit also, what will happen, your capital gain will be 2 lakhs. On that entire 2 lakh rupees of capital gain, this will be long-term capital gain under section 112A. Yes or no? Now this will not be exempt. Now don't you think that charging this 2 lakh under section 112A is not good? Because this 1 lakh, this 2 lakh includes this 1 lakh 10,000 gain also. And the gain happening on or after 1st February also. See, the gain which is happening after the announcement is made, it is always okay to charge tax on that. Because we announced, no, today 1st February we announced, no, that you still have the time to sell till 31st March. You did not sell till 31st March, meaning that you were comfortable in paying tax on the gain happening on or after 1st February 2018. Yes or no? But still, it is not justifiable to charge tax on the gain which happened prior to 1st February 2018, because that time the assessee, poor assessee, was not aware about this amendment which we are going to bring. That time that poor fellow was thinking that this gain will be exempt. And this gain also realized right now, and gain after this period is also realized right now. We want to charge tax only on the gain realized from 1st February 2018 onwards. Whatever gain which you know that it will now be taxable, that gain should be taxed, but not the gain happening prior to 1st February 2018. Hello, where you had that impression that this gain will be exempt. Now, if we take the cost 1 lakh, okay, and we are not allowing you the indexation also, just imagine by taking this 1 lakh, don't you think the gain prior to 1st February, which was long-term gain, which should have been exempt under section 1038. The assessee was thinking that this gain is exempt under 1038. Even that gain is covered over here. And the gain happening on or after 1st February 2018, that 90,000 gain starting from 2,10,000 to 3 lakh, 2,10,000 fair market value to 3 lakh, even that gain is covered over here. See, taxing this 90,000, covering this 90,000 for the purpose of taxability is okay. But covering this 1,10,000 is not okay. So what the government said, that see, you are transferring the shares on or after 1st April 2018. Meaning in our previous year you are transferring. But the shares which you are transferring right now, did you acquire these shares prior to 1st February 2018? Prior to 1st February 2018? Yes or no? Then do one thing. Don't take the actual cost as cost of acquisition. We will tell you what cost you should take. 55 subsection 2 clause AC, which I left that time, will be covered right now. So 55 subsection 2 clause AC talks about the cost of acquisition of these type of shares which were acquired prior to 1st February 2018. Hello. But transferred on or after 1st February 2018, and for that long-term gain under 112A is to be calculated now. Understanding? So what will be the cost now? They are saying that actual cost, this actual cost which you are taking, this actual cost should not be taken. You are supposed to take cost as per 55 to AC. What cost you are supposed to take? Cost as per 55 to AC. Now what is 55 to AC saying? That see, A, you take the actual cost, or B, you take the fair market value as on 31st January 2018. What was your actual cost? Come on, tell me. In our case, the actual cost was 1 lakh. And the fair market value as on 31st January 2018, in our example, it was 2 lakh 10,000 only, no? So either you take 1 lakh as cost or you take 2 lakh 10,000 as cost, whichever is higher, you take that amount as cost. But remember, this cost will be taken only if the shares, equity shares are acquired prior to 1st February 2018 and now they are getting transferred on or after 1st April 2018, and the long term gain is calculated under section 112A. So to calculate the long term capital gain of these type of shares which were acquired prior to 1st February 2018, you are supposed to take their actual cost also, can be taken as cost of acquisition, or you are given the option to take the fair market value as on 31st January 2018 as their cost. Whichever is higher you can take. Hello sir. Whichever is higher you can take, no? So A or B, whichever is higher. Which is higher? 2 lakh 10. So as per 55 2 AC, what cost you will take? 1 lakh you cannot take now. Actual cost you cannot take. Now you will have to take 2 lakh 10,000. As per 55 2 AC. Will you remember this? Okay sir. So out of 3 lakhs, don't reduce 1 lakh, reduce 2 lakh 10,000. So now your capital gain will not be 2 lakh. It will be only 90,000. Meaning this is already eliminated now. If we don't allow this cost now, this 1 lakh 10,000 will be included in your capital gain and will be charged to tax. Do you want to pay tax on this 1 lakh 10,000? Even if you want, we don't want to take. Because that 1 lakh 10,000 is the gain for the period for which the gain was exempt and you are not aware about the amendment. So any gain prior to 1st February 18, we are not going to charge. This is known as concept of grandfathering. Concept of grandfathering. Just remember, even if you don't remember, no problem. This is known as concept of grandfathering. Okay, now please pay attention. Please pay attention. Can I twist my example a little bit? Can I twist my example? See, this was my first case, no? This was my case number 1. Now in the case number 2, what I will do? I will take the same to same example. Same to same example, okay, no? See. What I am doing, Now what I will do? The fair market value is higher than actual cost. Getting my point? Fair market value is higher than actual cost. Shift this side, sir. Okay, yes. Now, fair market value is higher than what? Actual cost. But the selling price is lower than fair market value. Can I say the selling price is only 2 lakh? Not 2 lakh, take it 1 lakh 60,000. Possible? This can be possible, no? So the gain for the period is 1 lakh 10 exempted. But after that there is no gain, there is a loss of 50,000. Hello? So net gain of how much? Still there is a net gain of 1 lakh 10 minus 50. Still there is a net gain of 60. See, no? 1 lakh item you are selling for 160. There is a gain of 60 only, no? So your gain for that period got eroded. The gain for that period was 1 lakh 10, but you could not sell it for 210. You sold it for 160. Yes or no? So that gain of 1 lakh 10,000 got eroded by 50,000 and it came to 60. But still this 60 is for that period only, no? Still that 60 is out of that 1 lakh 10 only, no? We don't want to charge tax on that. But wait. We'll give you the cost like this only, huh? Cost like this only. So if you will take the cost like this, okay, now pay attention. Ayyo. Copy. Now if you will take the cost like this, in this situation you are taking the cost like this. What was your actual cost, friends? Your actual cost was 1 lakh. Okay. Now your fair market value was 2,10,000, whichever is higher. So if I take this, and now redo the calculation, what is my selling price? Come on, tell me. Now my selling price is not 3 lakh. My selling price is 1 lakh 60. So my full value of consideration will be now 1 lakh 60 only, no? Hello, sir. So full value of consideration, which is nothing but my selling price, will be 1 lakh 60 minus transfer expense. Let us say there was no transfer expense, so net consideration was 1 lakh 60. Now they are saying that have you acquired the shares prior to 1st February 2018? I said yes. And are you transferring on or after 1st April 2018? Yes. In 24-25 I am selling. So take the cost. Take the cost as per 55.2 AC. Okay, 55.2 AC says take the actual cost or take the actual cost or take what? Fair market value, whichever is higher. So I said okay, 1 lakh or 2,10,000, whichever is higher. So what will be there? Cost of acquisition will be 2,10,000. Now there will be a loss of 50,000. This is my long-term capital loss. Don't you think I have calculated a loss? And now this loss I will set off. Even if I am not in a loss, still I have calculated this loss. Meaning only the gain or loss for the period after 1st February 2018 will be considered. So gain after this period has to be considered. Loss after this period has to be considered, but you are not in the loss. Earlier you were in the gain of 1 lakh 10 till January, then your loss came down by 50, but still you are in a gain of 60, no? That 60 is out of 1 lakh 10,000 prior to 1st February 2018. We don't want to charge tax on that. But that does not mean that we'll allow you to calculate this loss of 50,000, hello, which you have not actually incurred also. But if we are giving you to take the cost like this, you are bound to calculate this loss, which has not actually happened to you. And now we will have to allow you this loss as a set off. This loss actually you have not incurred. 1 lakh worth of shares you are selling for 1 lakh 60,000 gain is only there, no? But that 60,000 gain relates to the period prior to 1st February 2018. We don't want to charge tax on that. But that does not mean that you will calculate this loss, which happened for a period after what? After 1st February 2018, because this loss you have actually not realized only. Getting my point? So you should not be able to calculate this notional loss, which has not actually happened to you, We will not allow this thing to happen. So to stop you from claiming a notional loss, what we will do, we will allow you to take actual cost, or we will allow you to take the fair market value. But remember, we'll put a restriction on your fair market value, that your fair market value cannot be more than your selling price. So take the fair market value as on 31st January 2018, or your fair market or your selling price, whichever is lower will be taken as your B. So what was your fair market value? Come on, tell me. 210. Hello, fair market value was 210. So I will write 210. 2,10,000. What was your selling price? 1 lakh 60. I'll write 1 lakh 60. Which is lower? 210 is lower or 160 is lower? 160. Meaning that will not allow your fair market value to be more than 1 lakh 60. If your selling price later on becomes less, meaning that the gain from 1st February to date of sale, it will be a loss, and that loss you are going to claim. as a set off, which loss have not actually incurred. You have not actually incurred that loss also. So we will not allow you to calculate that loss. So to stop you from calculating that loss which is not actually happening, we have to restrict your fair market value to selling price. Getting my point? So your fair market value or your selling price, whichever is lower. So out of these two, what is lower? 1,60,000. You can take this as your cost. Fair market value up to 1,60,000 you can take as cost. Either this or 1 lakh, whichever is higher. Still you can take 1,60,000. Getting my point? So now instead of 2,10,000, here what you will reduce now? Instead of 2,10,000, now you will reduce 1,60,000. So the fair market value 2,10,000 will be restricted to 1,60,000. Entire fair market value we will not allow. We will allow the fair market value to the extent of 160 only, which is equal to your selling price. Got it? This 160 you reduce. So your long-term loss, notional loss will now not be calculated, and there will be no long-term gain, no long-term loss, nil. Entire 60,000 which was the gain for the earlier period will also be exempted, and the entire gain for the period prior to 1st February 2018, 1,10,000, that will also be exempted, and the loss happening after this period will also be ignored. No capital gain, no capital loss. You forget about, we have forgotten about your gain, so you forget about your loss also. Okay? Hello sir. Now tell me, should I give you another case now? Third, last case. What will happen? Wait, I will take this only. Now what I am doing, please pay attention. Huh? This, this and this. Possible? 3 lakhs became 2,10,000 and 2,10,000 became 1,60,000. Can it happen? From the beginning only, you did not pick up the correct shares. Forget about sleeping with a piece on 31st January night. On 31st January night, you are already in tension that your value of the share has already come down to 90,000. Come down by 90,000. 90,000 loss, you are already there in a loss. Now after this you are further there in loss. Getting my point? See, the selling price can be higher than 210 also. Selling price can be lower than this also. Getting my point? So let us take this example now first. So what is happening? 3 lakh worth of shares you are selling for 1,60,000. Isn't it 1,40,000 actual loss? Cost was 3 lakh. You are selling them for 140. There is an actual loss of 140. Take the cost like this. Take the cost like this. 1,40,000 loss will be calculated. Real loss will be calculated. But we will not allow you to calculate notional loss. Real loss will be calculated 100%. See, what we will do? We will take selling price which was 1,60,000 only, minus transfer expense, no transfer expense, 1,60,000 will be net consideration, minus cost of acquisition. Now to calculate the cost of acquisition, we will take actual cost A. Actual cost. What was the actual cost? Come on, tell me guys. Actual cost was 3 lakhs. Or B. Or B. B is what? B is fair market value as on 31st January 2018. What was the fair market value? 2,10,000. But that fair market value cannot be more than the selling price. So either the fair market value or the selling price, whichever is lower, that will become my B. Yes or no? So I will take 2,10,000 or 1,60,000, whichever is lower. So I will be taking 1,60,000. 1,60,000 or 3 lakhs, whichever is lower. No, whichever is higher. 55 to AC, take actual cost or fair market value, whichever is higher. No? Hello sir. So what cost you will take now? Will you take 160 or you will take 3 lakhs? Definitely 3 lakhs. Take 3 lakhs. Reduce 3 lakhs. The actual loss of 140 will be calculated. This is your long-term capital loss. Will be allowed as a set off and carry forward. This is your actual loss. Getting my point, sir? Yes, sir. Now, you can make hundreds of cases like this. Every time we have to see, are the shares acquired prior to 1st February 18? Yes, sir. Are they transferred on or after 1st April 2018? Yes, sir. Long-term capital gain under section 112A has to be calculated? Yes, sir. Cost must be calculated like this only. Cost must be calculated like this only. Nothing else will be the cost. Okay. Now wait. When did you buy the shares? Here. When did you buy the shares? On or after 1st April 2001. Hence you are taking this actual cost. In point number A. If the shares are acquired prior to 1st April 2001, then actual cost or fair market value, whichever is higher, will become point number A. Understanding, no? What if the bonus shares were acquired prior to 1st February 18? Actual cost nil. Or fair market value as on 31st January 2018, or restricted to the extent of selling. For bonus shares also same thing has to be done. For all the type of equity shares, you are supposed to do it like that. Put this into format, take the amounts and do whichever is higher and lower. You are going to get the correct amount of cost. Will you be able to do it? Sure, sir. Sure. Now what if, guys, what if the capital gain which you are calculating right now under section 112A, this capital gain, long-term gain which you are calculating under section 112A for these assets, okay, transfer is made on or after 1st April 2018 through recognized stock exchange, STT is also paid, okay. Now whatever capital gain you are calculating this long-term capital gain. So this cost of acquisition will be taken as per 55(2) AC. Yes or no? Here. What you will do? COA as per 55(2) AC. Do you remember? And what will be the COA as per 55(2) AC? That we have already seen. What? Come on, tell me. A. Actual cost, or B. fair market value on 31st January 2018, or selling price. This or this, whichever is lower, take this as B and take actual cost. Yes or no? A or B? A or B, whichever is higher. And if the shares are acquired prior to 1st April 2001 also, then this actual cost or fair market value as on 1st April 2001, whichever is higher, that will become A. If bonus shares are there, do the same thing. Getting my point? Now please pay attention. Long-term gain you are calculating. Okay. Under section 112A. Under section 112A, long-term gain you are calculating. This long-term capital gain, cost of acquisition you will be taking like this, but take this cost only if the shares are acquired prior to 1st February 18. What if the shares are acquired on or after 1st April 2018? Then in this case, 55(2) AC will not be applicable. Cost of acquisition will be actual cost only. That's it, sir. For bonus shares also, the same thing will be done. Done, sir? Now, will you be able to calculate the capital gains under section 112A? Whatever the question is there. Now, however difficult question they are putting in the exam, you will be able to crack that question for sure. There is only one question in our ICI study mat which is there on this concept. Question number 1 of test your knowledge. Question number 1 of test your knowledge. Okay, no? That I'm going to solve with you. Don't worry, don't worry. I'll be solving each and every question which is required to be solved by me. Okay? Now pay attention. Did you understand this entire calculation? Now see, can I say STCG under section 111A and LTCG under section 112A? Okay, no? Both of them are taxable at concessional rates. Okay. Why they are taxable at concessional rates? Because STT is levied on what? Transfer. Because STT is levied on transfer. The STT paid short-term gain, STT paid long-term gain will be covered by 112A and 111A. Yes or no? What if STT is not paid? Can there be a transaction on a recognized stock exchange where you transfer also but you don't pay STT? Not possible, not possible, not possible. Whenever you will transfer on a recognized stock exchange, always the STT will be charged. Even if you are the Prime Minister of India, if you are selling through a recognized stock exchange, STT will always be charged. Don't worry. But wait, there is one exception. There is one stock exchange in IFSC. IFSC, you know? That bank code? No, I'm not talking about that. IFSC, I want to say International Financial Services Center. Just like special economic zones are there, no? SEZs, special economic zones. Just like special economic zones, one specific geographical location is identified by the government and the government is saying, see, this is International Financial Services Center. So there are many zones which are identified in India as special economic zones to do the business, do the export business. So just like SEZ, there is a special economic zone identified by the government, but the government is not calling this zone as a special economic zone. This particular geographical location is known as International Financial Services Center. There is only one IFSC in India. Only one IFSC in India. See, you can have multiple SEZs in India. Okay, no. But in India, there is only one IFSC. You know where is it? Where it is? Gujarat. Very nearby to my house. Ahmedabad to Gandhinagar. Gandhinagar is the capital of Gujarat. Okay, no? So Ahmedabad to Gandhinagar, there is one, highway. So when you come out of Ahmedabad, but before you reach Gandhinagar, there is a place in between. That place is notified as International Financial Services Center. And that place, we all call it Gift City. That place is actually named as Gift City. Gujarat International Financial Tech City. Gujarat International Financial Tech City. In short, it is known as Gift City. This is what? This is IFSC. What is this, guys? This is International Financial Services Center. Now, whoever is providing financial services like insurance services, brokerage services, services related to capital markets, banking services, yes or no? All the assessees, all the people who are providing their financial services, but they are not providing those financial services in India. They are providing their financial services outside India and they are earning valuable foreign currency for the country. All of them are invited come here. Come here and start doing your business here. So if you are providing financial services, so you are providing financial services outside India. Why are you scattered all around India? If the government wants you to be here, be here. The government will give you state-of-the-art infrastructure. Government will provide you the facilities which are required to grow your business. All the technical support will be given. Immediately your queries, immediately your problems will be resolved. But for that you need not be scattered all around India, no. All of you all come and gather here. From here, this is the financial hub. From here only start doing your business. Start providing your financial services and earn valuable foreign currency for India. The government will give you immense benefits in terms of infrastructure, in terms of support, everything. Whatever things are required for growing your business of providing financial services, the government will provide all the facilities, which is not possible for the government to provide if you are scattered all around the country. And as a result of that, your business is not growing. As a result of that, you are not able to earn valuable foreign currency in volumes. We want you to earn foreign currency in volumes, and that is possible only if we will support you. Come here, start doing your business. So people from the assessees from all across India are slowly and gradually gathering here. And from here, they are now providing financial services, yes or no, outside India, and earning valuable foreign, all the banking related services, your insurance related services, mutual fund related services, all the services which you are providing outside India. Even the capital market related services are provided. So the business houses who are doing their business from there, what will be their main business? Financial services. All the finance sector related, all the services, the assessees will be there. Now there is one stock exchange in IFSC. In the IFSC, no, there is one international stock exchange. Just like Dubai Stock Exchange, just like New York Stock Exchange, just like London Stock Exchange, there is an international level stock exchange opened here. Here, no, the Indian government of India wants to create a stock exchange which is renowned all across the globe. The name of the stock exchange should be so big as London Stock Exchange, as Dubai Stock Exchange, as New York Stock Exchange. All the shares of all the foreign companies which are traded in NSE, London Stock Exchange, those same shares will be traded here also. So those shares are listed in this stock exchange. And the buyers and sellers of all around the globe, they come on this stock exchange and they trade here in foreign currency. Valuable foreign currency comes to India. Getting my point? And to have that, we cannot charge STT, no, on the transactions happening here. So any buying and selling transactions on this international stock exchange, whatever the buying and selling transactions happen, those buying and selling transactions happen in foreign exchange. And on these buying and selling transaction, the government does not charge STT. No STT is charged. Now tell me, if any listed equity share was listed on this stock exchange, at the time of buying also no STT paid, at the time of selling also no STT paid. So the gain will be STT paid short term gain, STT paid long term gain? No. Will it be covered by 111A? Will it be covered by 112A? Will it be taxable at concessional rate? The answer is yes. Even if no STT charged on this stock exchange on buying and selling transaction which are happening in foreign currency, even if STT is not charged, any buying and selling transaction happening on this stock exchange resulting into short term gain and long term gain will still be covered by 111A and 112A. will be taxable at concessional rates only. Will you remember this? Sure, sir. Okay. So this was your 112A and 111A. Short-term gain, normal rates. All the other short-term gains, normal rate. Short-term gain 111A, taxable at 15% or 20%. Depends that when the transfer took place. Yes or no? Long-term gain from same assets. Friends, long-term gain from same assets will be taxable will be taxable under 112A. First 1 lakh no tax. Over and above that 10%. Then the limit has been increased. First 1,25,000 no tax. Excess 12.5%. But how to calculate this long-term gain? What cost should be taken? We have already discussed that. Okay, no? Now please don't forget that. Now any long-term capital gain arising on transfer of any other capital asset taxable as normal rate. No. Now it will be blunder. See, I had copied no from there. So now here any other capital asset transferred and long-term capital gain is there. So that will be covered under section 112. Very easy, sir. Very easy. Now when you will go to 112, no? Hello? When you will go to 112, so now I am talking about what? Now I am talking about long-term capital gain on transfer of any other capital asset. The capital asset which is not covered by 112A, guys. The capital asset which is not covered by 112A, any other capital asset, yes or no? If you transfer any other capital asset, the long-term capital gain will be covered under section 112. Now what 112 says? If transfer of capital asset was prior to 23rd July 2024. So what was the old rates? I'll tell you. In case of unlisted shares or shares of closely held company, if this was your capital asset, so long-term capital gain you are calculating on this asset. Hello, sir. If long-term gain you are calculating on this asset, then 10% this long-term capital gain taxable at what? 10% without indexation and currency fluctuations in case of non-corporate, non-resident, in case of non-residents and foreign companies. So if you are a foreign company or you are a non-resident and you have transferred this asset and you are calculating long-term gain, see, we are not going to charge higher tax from you. We will charge only 10%. We want to attract you people. Come to India, invest in these kind of shares. Okay. So to attract you, your capital gain tax rate will be very less. The long-term gain will be there. We will charge only 10%. But remember, we will not give you any indexation benefit or currency fluctuation. Also, we will not consider. Okay, no? So benefit of currency fluctuation will not be allowed and benefit of indexation will also not be allowed. Your capital gain will be calculated without indexation and without currency fluctuation, and the entire long-term gain will be taxable at flat 10%. Now, if the same shares are transferred by any other person, then it will be taxable at what percent? 20% with indexation in the case of other assessees. So see, the capital asset is same. Getting my point? But who is transferring that asset, that is important. If it is transferred by non-resident or foreign company, the rate will be 10% without indexation, without currency fluctuation. If that same asset is transferred as a long-term capital asset by any other assessee, any other person who is not a non-resident or a foreign company, then in that case the tax rate will not be 10%, it will be 20%, but indexation benefit and everything will be granted. Yes or no? If the transfer takes place prior to 23rd July, you are supposed to consider these rates only, which I am going to discuss now. Yes or no? Now see, this same thing, no, I have written here. The same thing I have written here. Please pay attention. See, unlisted shares. This thing I have told you. 10% without benefit of indexation and currency fluctuations. And for non-corporate, non-resident and foreign companies. Yes or no? Or 20% with indexation for all the other associates. This only I have told you right now. Okay. Now pay attention. What if you are transferring listed securities? Listed securities other than units, or zero coupon bonds you are transferring as long-term capital asset. The period of holding is more than 12 months. So after holding for more than 12 months, you are transferring them. Long-term gain you will calculate. That long-term gain will be taxable either at the rate of 10% without indexation or 20% with indexation, whichever is more beneficial for you. And this option was given to all the assessees. Will not be seen that which type of assessee you are. All the assessees. Calculate the capital gain without indexation, apply 10% rate, or calculate the capital gain. Calculate the capital gain by taking 20% tax, by taking indexation and apply 20%. If indexation was available, take 20%. After claiming indexation, take 20%, 10 or 20, whichever is more beneficial, pay that. But this will be applicable only if the transfer was made prior to 23rd July. Any other capital asset, no, any other capital asset other than these four assets, any other capital, building is there, land is there, shares is jewelry is there, paintings are there, all the other assets will be now covered here. Indexation benefit will be available and taxable at 20% for all the assets. This is if the transfer is made prior to 23rd July. What if any of the capital asset transferred as long-term capital asset on or after 23rd July 2024, no indexation. Period of holding will be changed. No indexation. Cost will be reduced without indexation. On the entire capital gain, which you calculate without indexation, you are supposed to pay 12.5%. For all the assets, now it is same. Different treatments were given. No, now no different treatment. All the capital gain taxable at what? 12.5%. Even the capital gain arising to a resident individual or HUF for immobile property which was acquired prior to 23rd July but transferred on or after 23rd July, for that resident individual HUF, in case of this immobile property also the rate is 12.5%, but he will be given one option. Only in this one case the option is given to calculate the capital gain with indexation and calculate the tax at the rate of 20%. So these type of individuals, okay, transferring immovable property which was acquired prior to 23rd July and transferred on or after 23rd July will get the option to pay tax 12.5% without indexation, 20% with indexation, whichever is more beneficial. But for others, no option, 12.5% without indexation. Any other asset, any assessee, 12.5% without indexation. Getting my point? Now the tax rates have been rationalized. Why to make them complicated if they can become easy? They are made easy, but still complication is there in the case of individuals. This you have to remember. Will you remember these tax rates? Sure. Now some important discussion is remaining. I will not extend now. Okay. Tomorrow we are meeting at 3 to 8:30 or 9. We'll strike tomorrow. Okay. See you tomorrow. Bye. Bye.